A very good morning. It's finally Friday, but the markets don't seem to be in a weekend mode. Asian markets mixed. We've got some data out of China. The Nifty is struggling at the lower level of the range that it's been holding out. So I don't think the bulls have it under control, unfortunately, this morning either.
It's not TGIF. Maybe it is. Thank God the markets will be shut for 2 days, but not in a positive note at all.
Yeah. Weak earnings, FI selling, and viewers, we are going to get some splendid data of where FIs are selling sectorally.
Yeah.
So Chinmay Vasdev, our colleague, will come in and lay out where FIs are selling sectorally, which is great. But just before we start on this, I thought that exchange on X was very interesting, wherein Mohandas Pai comes out and says that government, PMO India, etc. Why is it that Bengaluru hasn't got an AI center of excellence? And I think he's put out a tweet which we should try and get up because we'll have those graphics. But Mohandas, so
the bugbear is that it's in UP.
Yeah, and then finally it took somebody of Sridhar Webbu's stature to come out and say, hey, I was on the committee. And listen, the committee is, in its own wisdom, chosen these 3 centers of excellence. Please do not get the north-south divide out here, at least. I think it's a very important exchange, really, in the context of what's really happening in the country as well currently.
Yeah, of course. And Uttar Pradesh is one of those centers. And what Sridhar Wembu comes out and says that, in fact, most people on the committee that made the decision of the locations are from the southern part of the country. So let's leave the north-south divide out of it. Yeah, interesting exchange there.
Yeah, he's put out, sorry, just 20 more seconds. He said, a lot of southern cities put out very strong proposals, but the ones that we selected stood out in the end. The committee was unanimous in its decision. The last line, I beg people not to inject north-south politics in this. Very important.
Yeah, that goes for all kinds of politics. But let's get to the business of the day and start with what's happening with global markets and those cues. Looking positive overall, nothing great for India though. So India is on its own, painful journey right now as far as markets are concerned. But in US markets, mixed day. Dow closes at its highest level, like a record high. But overall, muted on the S&P 500. The Nasdaq also mildly up in the green. Netflix was the big story after hours. After markets shut, the stock popped 4% because of its EPS increase. It's beaten on all estimates. So that was the big story there. Treasury yields rose slightly because of positive economic data, the 10-year at 4.09. And the 2 sets of data that came in yesterday were important. So retail sales, for example, have risen 0.4% versus estimates of 0.3% in September. Weekly jobless claims also fell to 241,000. So that was a positive as well. Crude showed some rebound after a losing streak. Brent was under the $75 levels. Meanwhile, Asian markets important to see because some data has come out just half an hour ago from China. So mixed levels for Asian markets, but the Shanghai about 0.5% down. So here's what's happened. Q3 GDP in China has grown at 4.6% year on year versus estimate of 4.5%. So actually slightly above estimates. The Shanghai index is still down in the red. September retail sales have risen 3.2% versus estimate of 2.5%. So positive there. The Jan to September GDP is pretty much in line, but fixed investments have also been good, as have industrial output. So some positive data coming there out of China. Implied open for India, though, looks rough. And the largest culprit there, possibly fund flows, 120 points down on the Nifty. Look at the fund flows from yesterday. FI is selling 7,421 crores. DI is buying 4,980 crores. But, the figure which I actually found very startling is that the FI exits in October have crossed record levels. So 71,392 crores have been sold in October so far by FIIs. The last record figure was after COVID in March 2020, which was 62,433 crores.
And from, I think, what we saw as well, every single day of October has seen a net sell figure from FIs.
Yes. So they're running for the exit door, not even moving there. And that's, I think, what's keeping the sentiments down, amongst other things.
Yeah, most certainly. And it was a bad day yesterday as well, right? Because while I was absent in action, I saw the charts and they've trended lower and ended at the lowest point of the day, Samina, if you will.
It was a tough day, and it's been tough. The last 3-4 days have not been easy if you're a bull on the street. We got a decently weak handover. We thought, we would defy that because that was what we had in terms of indication and early trade. But 25,000 so swiftly got taken out even after a touch and go. By the time we closed shop, the market was down almost 0.9%. We are down nearly 1% for this week, and if we close lower and cannot recoup any of those losses from the early part of this week, which is very likely from what implied Nifty is indicating, this is going to be one of the longest selling streaks in the market. So it's been 3 straight weeks of losses for the Nifty. We hadn't anticipated such a tough October, but it seems like it is tough. Well, what also stood out was not just the Nifty, but look at the Nifty Next 50. That was a big fall, 2.5% low on the Nifty Next 50. So pressure was very obvious. And this didn't only come in from the frontline names, but the Nifty Next 50 also bearing the brunt of a weak sentiment. Broad-based selling, barring IT, that was the only green that we saw on the screen yesterday. Every other sector was down and out. Well, just to highlight for you what happened on Bank Nifty as well, there were some hopes in some quarters of the market that believed that Bank Nifty may continue to see follower buying and outperform the benchmark. While Bank Nifty for the week is marginally higher as compared to the index, it is struggling as well. We've gone back down to levels of 51,200, which is an important level of support on the index. A very good possibility that may get taken out if the market remains weak for most part of today. Well, we're also trading below the 100-day moving average. So that is very important for the Bank Nifty to be defended, which stays at 51,200. Any close below that will take us down to levels of sub 51,000. Well, auto stocks, and I don't know whether we are attributing this to that big Hyundai IPO that had opened up for subscription, but for the whole week, auto has been very rough. Auto stocks are down 6% in the last 5 trading days. So the index itself has seen a cut of 6%. These are the kind of numbers you see on individual stocks, but here it's the index that's given up 6% gains in the last 1 week, yesterday being one of the worst days for the auto pack. Stocks like Bajaj Auto reported numbers. Numbers were largely in line with street expectations. Maybe a little bit of caution that the festive season is not looking great could be one reason why the stock sold off. But the other very apparent reason is that the stock has doubled in the last 1 year. So let's not forget that some profit taking at higher levels was only warranted from the way the counter has, reacted or traded in the recent past. Metals, once again weak. It's been buy today, sell tomorrow trade on the metal pack. China has once again disappointed on stimulus, so they've not explicitly stated or put pen to paper. It seems like it's only lip service for now in terms of the stimulus coming in from China, on back of which every stock in the metal pack, barring Nalco, has sold off very sharply in trade. Infosys reported numbers post-closing. So you had Infi, you had Wipro, LTIMindtree, Polycab, Tata Chemicals, which reported earnings after close. These stocks, of course, will react today. But from my last check, Wipro and Infosys ADR on Wall Street had it really bad. So both those stocks were down over 4% in the ADR trade, right? Which means that there could be pressure on these IT stocks in today's day of trade as well. Wipro and TCS, in fact, like I said, the ADRs were under pressure. So you will see the follow-on selling coming into these counters, even though the numbers were not hugely disappointing, or at least on Infosys. So that's what we have in terms of recap. It's going to be one of the worst sort of, selling that we've seen in the last 6 to 8 months. We've had 3 straight weeks of losses. Niraj, we had a whole bunch of earnings, but they all largely seem to be in the subdued category. The Nifty is struggling. I mean, it's going to have to defend 24,900. If it doesn't, we're going down to 24,700 from the look of it.
Yeah, I mean, so at 24,750 or thereabouts already,
is the 50-day moving average. Yeah.
And if we are starting off about 100 points lower, so kind of closing below that. But, I think the larger problem is if Bajaj Auto on 30 times FY27 EPS can be smashed the way it was yesterday, what will happen to SMIDs which are trading at 50 times with hardly any earnings to show? So I think therein lies the problem.
But and cash flows to show, more importantly. Just to talk about Bajaj Auto and the auto pack, I don't think, at least before the stock sold off, there was not a single word on the street that the numbers were disappointing. There was maybe a little bit of caution that the festive demand may not be great. It was almost as if the street was reacting to Bajaj Auto after it posted earnings, saying, you know what, the stock's corrected, the outlook doesn't look great, it's now suddenly become a very expensive stock. So we've pretty much found a justification
So the numbers...
After the counter opened 10% lower yesterday.
There was one report.
There was only one report.
No, but independent of that, the justification was that if the street is expecting 8-9% and the growth has come in at 3-4%, should the stock be punished? Yes. But the point that I'm making is, if Bajaj Auto, with its commentary, can be punished 12% in a day, which is a cash flow generating company, and trading at 30 times FY27 EPS, I'm not saying it shouldn't be punished.
Do you not feel it was an auto fund rebalancing that could have taken place with Hyundai making its way in, getting the kind of oversubscription we saw?
No, I think
Monday was weak for Maruti, M&M, Shriram Finance, a whole bunch sold off. Tuesday, they've sold off as well. Wednesday, you had your TVS, you had your Bajaj Auto, everything coming out, and we see the subscription numbers on Hyundai.
But the point that I'm trying to make is that, okay, two parts here. First, on autos, and this is my view, your view could be different, and everybody's view could be different. Okay. No, but the point is that the street was parked in two-wheelers because the street was saying four-wheelers is not growing.
Happening.
So
Correct.
therefore, go overweight two-wheelers because two-wheelers will deliver growth, rural is picking up, etc. Suddenly, you have one of the premier companies coming out and saying, hey, you expect us to grow 10%? Sorry, we are growing only 3-4-5%. So therefore, should that froth be taken out of that system? I think that. But the larger point that I'm trying to make is, if Bajaj Auto, which is a cash flow generating company, can be punished so much while it's trading at 30 times FY27, not cheap, but not as expensive in some of the others which are trading at 50 times, 60 times, and growth is not as strong as well. Cash flows are not as strong. I mean, imagine what will happen once these numbers start coming. I fear for Q2 earnings season.
So that, we had those red flags. Everyone we spoke to had said that Q2 could be tough, and there seems to be no patience on it. And, on the point of Bajaj Auto, and that's one of the stocks that I'm talking about today as well, it was a bit overdone. It was a bit overdone. So you could maybe see some response there. But anyway, before we get to the stocks, the trade setup.
Yeah, just one seemingly obvious thing, and there is a lovely note that has come in post-market hours from Nalwala yesterday, which speaks about how their proprietary indices indicate a growth slowdown. So could that hurt markets? Remember, markets don't necessarily follow GDP growth, but at a period of wobbly news flow, if indeed our growth, which was supposed to be high, starts showing some issues, there is a problem. Autos, high frequency indicator of growth slowdown, getting punished. It's very difficult to call out bottoms, and I think now the street is learning that it's better not to predict too much. But I think index is near some recent bottoms. Maybe not quite there, but very near some recent bottoms. And let's see if there is a bit of a recovery. Yes, Samina was pointing out, it's around those levels from where it's bounced back as well. Let's see if that happens too. And just somehow I get a feeling that tech is unlikely to give a very strong aid to markets. The Nifty ADR was a giveaway, Vipro Q3 numbers. We'll talk about it, but tech unlikely to give too much of support. So let's wait and watch what happens there.
I don't think support is coming from anywhere this morning from the way things...
Metals maybe, if China is positive, if at all.
We'll have to wait and see, right? But it looks like it's going to be a tough morning. We said Infosys and Wipro ADRs did sell off quite sharply. But again, I don't know why that reaction, because those numbers, while have missed estimates on the profitability side for Infi, they've reviewed their guidance upward, or rather revised their guidance upward. An increase of 50 bips was already baked in, but they've increased it by 75 basis points. There's been an additional 25 bips increase in the guidance of Infi. Maybe because the stock has gained, has been an outperformer. We are seeing some selling that's underway, pretty much like a Bajaj Auto case that we saw. But for now, we'll highlight for you the numbers and take you through what brokerages also have to say. In terms of revenue is up 4%, EBITDA was up 4.7%, margins have been flat at 21.2 versus 21.1. Net profit was up 2.2%, so flattish at 6,500 crores. This is where the expectation was running much higher. They have declared a dividend. They've raised their FY24 constant currency guidance to 3.75 from 3.4 on the lower end to 4.5%. And they've retained their operating margin guidance at 20 to 22%. But all in all, decent numbers, profits have missed, guidance has been reviewed upward, ADR was under pressure. So good chance that the stock will see a gap down in today's day of trade. Well, I've not picked up Wipro and the other tech companies, but what I do want to highlight is what happened on Tata Chemicals. Numbers were painful. When you look at it, how bad they were, you will have your heart sink. But of course, the flip of it is, it's been better than what we've seen in the last few quarters for Tata Chemicals. Profits down 46% to 267 crores, so almost halved on profits. Revenue has remained flat. EBITDA has fallen 25%. Margins are also down significantly at about 15% versus 20%. There was no exceptional gain. versus 102 crore number that we'd seen in the same quarter last year. What stands out is soda ash demand is now stabilizing a little bit in our country. Container glass demand in America and Europe still remains muted, and the outlook is not too positive either. Heavy rains in July and August have also impacted operations in the country. Overall performance, some may view it as better than the previous quarter because they've sold a little bit more. But of course, the fact remains that the outlook does not look too promising, and I think that's what the concern is. Morgan Stanley on Tata Chemicals has maintained its underweight with a target price of 881, which is a potential downside of nearly 20% from where the stock closed yesterday. So those numbers look weak. Soda ash demand is stabilizing, but it doesn't seem like there's going to be much to hold on to because bad weather, Kenya exceeding expectations, the fact that Chinese production is also happening. So all that together will limit margins. The other one that I want to quickly highlight is CEAT. Again, bad numbers there. Profits are down 42%. Revenue is up marginally. EBITDA has fallen 20%. Margins are down nearly 400 bips, coming in at 11% versus 15%. Raw material basket has increased as compared to the previous quarter. Margins have shrunk. There's been an increase in employee cost. One thing that stood out was their debt has also increased pretty significantly due to higher working capital requirements. So all in all, CEAT weak numbers. Tata Chemicals, it's a bad quarter once again, but relatively less bad than what we've seen in the last few quarters, but the outlook not looking good either as per Morgan Stanley.
Okay, I'm going to try and do this quickly because we have a very exciting guest who's waiting to speak with us. Let me try and give you the short bulletin version. Wipro, thumbs down, and the reason is their revenue guidance. Their beat on revenue and profit estimates. Revenue growth in constant currency was highest in 7 quarters. Guidance, though, was revised to -2% to 0% versus an estimate of -0.5% to 1.5%. That means you're coming out and saying that there is going to be no growth, and this is really what is going to hurt it. Put this into perspective as well, that you've seen that stock already run up on the 1:1 bonus issue. That news has now come, so it's in for a bit of profit booking. I won't go into all the details of what the numbers are, but let me just tell you what Bernstein and Macquarie are saying. Bernstein has maintained an underperformed target of 460 rupees, says guidance was underwhelming, revenue growth lagged peers, limited visibility of catch up. Reported inline quarter, total bookings in line, executed well on margins, but relative performance against large peers continues to be weak. Macquarie, meanwhile, maintains an outperform target of 670 rupees. So some positive views coming in there. Says revenue and margins beat estimates, profits in line. They don't seem too worried about the guidance because the large TCV was highest one in any quarter. Revenue was broad-based across guidelines. They do say would have hoped for better revenue guidance in Q3 given strong deal wins. Management has attributed muted growth due to furlough. So a tough one for Wipro possibly this morning. Axis Bank, on the other hand, is a thumbs up. Good set of numbers. Net interest income in line, margins the same sequentially. There's an IT refund item which changes that figure a bit, but if you take that out of the picture, not too bad. Other income was higher than expected due to trading profit. Trading profit reflected due to mark-to-market gains. Provisioning also elevated due to contingency provisions and retail unsecured. That stress is being seen across the board, but PAT was above line, growth largely in line. Just telling you what Bernstein is saying. They've maintained an outperform, target price of 1250 on Axis. They say good set of numbers, but low quality beat. Sequential improvement in credit costs, tight cost control and non-interest income aided numbers, but weak loan growth. Weak loan growth may be forgiven because that's an across-the-board problem as well. And the last one, Bajaj Auto. We've spoken in detail about it. So, I think that you'll see a bit of a bounce back today because the fundamentals have not changed of what bothered the street yesterday, but it was a bit in a oversold territory. So 13% down. You could see some reprieve coming in there on Bajaj Auto, but of course, we'll wait and see.
Yeah, a rapid fire before we get to Sandeep Tandon. He's waiting by 30 seconds. 3 stocks. Manappuram Finance will get beaten today. Very likely could fall a little bit today because downgrades coming in because its subsidiary Asirvad Finance has restrictions from the Reserve Bank of India. So Morgan Stanley, Jefferies, JP Morgan all have downgraded. Polycab, There was a margin miss, and therefore very likely that Polycab could see a bit of a hit today because of that. But remember, the top line growth was very strong. Let's see if that's an antidote. And gas companies have confirmed what the street feared yesterday. The administered APM gas quantities have been lowered for IGL, MGL, Adani Total Gas. So watch out for those two. But let's go across. Sandeep Tandon, MD and CEO of Quant Capital, with us on the show. Sandeep, great having you. Thanks for taking the time out, and such an important time to have you, because we are starting to see some jitters around growth. At least high frequency indicators from economists seem to suggest that. And earnings season, let's be real, hasn't started off very, very strongly. How does a large investment house like yours think about the landscape currently?
Niraj, as a house, we have been very vocal right from July, first week, early part of July. We have been talking about deterioration, global macro. We have been, based on our predictive analytics, we talked about going forward, we expect the employed volatility of the cross-asset, cross-market will spike. And data points are deteriorating. Risk appetite for India is also declining. The only thing which is holding the market globally, and it was holding in India for a long period of time, was the liquidity. So liquidity still remains elevated and still rising, and the other data points are changing. And that's the reason we as a mutual fund has taken a very cautious and very conservative approach, move our portfolio to defensive name, liquid name, from high beta to low beta. So all those things we have done in our portfolio, and we think I will wait for more data and clarity before taking a really aggressive view on the market. So right now, I think it's a wait and watch sort of approach, and data points, I completely agree. Many high frequency data, which we also track, is slightly deteriorating. And that's the only thing, with the help of predictive analytics, we were relatively early.
You tend to do this for so many years now, this whole predictive analysis, the book that you write, etc. What are levels telling you as well? Because I think you combine both high frequency data, maybe a bit of technicals data, all of that. What is your sense about what is the downside to this market currently, both based on global factors as well as local factors?
Niraj, I'm not a good technician. Okay, that's
agreed.
Okay,
but your book typically used to lay it out, right? That you see something like this. Yeah,
it's a more of a representation of in a graphical manner. Okay, but it is more of a macro and mathematical models which we run at our end, and we are predominantly a behavior house. So if you ask me from a behavior perspective, a lot of early signs of disturbances there in the market, and that's one of the reasons we believe that easy phase of bull run is over. We are in bull run, but in decisive bull run, but we are in difficult phase of bull run. Now you look at even the amount of frenzy which we are seeing in the IPOs, QIP, or any block, okay? When promoter don't see value in their own company, or they are booking profits, or they are selling, there's a queue by the best names in the world and trying to identify these stocks, and and wherever the queue is bigger, people are just standing to, because the logic is that market is moving up, there's no impact cost. I will get in without any impact cost. And these are like typically signs of worry for me. Okay. Look at some of the IPO got listed 100% premium on the listing itself. Within a week's time, 100% returns. So this sort of move, when you come, it gives you some kind of alert that some amount of frenzy is getting built. And whenever that sort of phenomena happen, it's a additional data point for you that one has to be slightly cautious. Okay, I'm not saying that this is the top of the market. No, India is a great story. Something has changed for India. Based on our perception analytics data, we can say India P multiple will remain elevated for a longer period of time. So a lot of people who believe that P multiple for India for last 6 quarters has been high, and that's the reason market is now corrected. They have been proven wrong for more than 6 quarters now. And I still believe that this thesis will not work. What we have to look at, don't look at data in isolation. Okay. And that's the reason in our research, we talk about multi-dimension approach or multivariance model. Because when we talk of multi-dimension, that gives you a better perspective. Let's say example, when you're talking about valuation, I agree, has been rich for a while, but it is not absurdly rich, where we need to say that we have seen a classic sign of euphoric happening in the market, which is not the case. Now, if you look at in one dimension, you don't get answers. But the moment you bring the second dimension of, let's say, liquidity, okay, Liquidity, what was the liquidity, let's say in 2000, today in 2024, liquidity is few hundred times. What was liquidity in 2000, let's say 8 or even 2018? 2008 was the classic 7-8 Lehman crisis, post-Lehman crisis. Best of the people thought that is the biggest liquidity wave we have seen in the world, okay, where all central bank came together. I'm talking about that's the way the QE started. But today, if you really look at the global liquidity, it is few times of 2008 also. So you cannot ignore, and that's the reason the beginning of the show I talked about what is driving the market is the global liquidity. And that is very important. You cannot. And third important aspect is the sentiments part, which we call it, risk appetite. The risk appetite is also have risen sharply in most of the market except the China, and China has just seen the reversal. So it's a combination. When you try to look at multiple data together, you get more clarity. See, 100% clarity nobody has. Okay, since we all operate in the world of uncertainty, if you get more, I will not say certainty, with more clarity, then you can take a better decision-making process.
Sandeep, hi, good morning. Tamanna here. You talked about the question of where global liquidity is going, and what is maybe compounding the pain from the Indian perspective is the FII outflows. Do you see that deepening? We've already hit record levels in the month of October, topping what we saw in COVID, post-COVID March 2020. Do you see that deepening as China is showing signs of resurgence? The data we saw this morning is perhaps better than most expected.
See, let's understand from the FIS perspective first, okay? The way we sitting in India, how we manage our risk. We manage our risk by stock rotation or sector rotation, because we as a mutual fund or domestic house has no other option but to play in India. And hence, our all risk mitigation strategy will revolve around these two theses, okay? But now look at the FIs. They have options to play in multiple countries simultaneously, okay? And if everything in life is not about absolute, it's also about relative. So on an absolute basis, they made tons of money in India in last 2 years or last 4 years. On a relative basis, China was in the inflection point few months back, or let's say in last month itself. And they saw some turning point with some government after a long period of time have taken some decisive step towards the stimulus. So it is whatever China is doing is some sort of easing only. Only the quantum can differ what people are expecting, very sizable. That has still not worked out, but direction is right. So I think the way I look at the FIs, they are opportunists and they are flipped. Okay. And this flipping thing, when the cycle starts, okay, it can last for a longer period of time than when we think. So unless China peaks out completely and Indian market bottoms out in a big manner, and that's the time the cycle can again reverse. So what we have to understand, a lot of people link with the hot money. It's not only hedges have moved out. Hedges are very quick. Okay. Even so-called what we have defined them a long account. I don't even call them long account. They are a trading account. They flip very fast because they trade globally. So if the trading accounts are also shifting, I'm not quite surprised because it's a data-driven approach if you look at, and they have opportunities. So they are doing it. And historically, you go back and check whenever China has done better, global market have not performed well. And in India, definitely it has, I will not say perfect inverse relation, but definitely when China performs, India tend to suffer. And this is the phenomena which is again repeating because it's based on this allocation towards emerging market, because India and China both are large part of the emerging market basket. So obviously, if you're shifting from earlier money shifted from China to India, and India was the biggest beneficiary. Now, some manner reverse has started, but I can only tell you from a structure perspective. This could be a short-term phenomena and which can last maybe a quarter or maybe few months. But if you look at from a perception analytics data for India, we think we are very constructive about India. India will remain reasonably strong from long-term perspective. So India for me is a buy on dip strategy. If you are a long-term investor, I don't think one should be too much worried about this short-term correction or consolidation which India is going through. The thesis, it should not happen that you try to move out in the current environment and you miss out the biggest bull run in your life. So that's the way we define that this decade belongs to India, maybe half century belongs to India. But again, after making these bold statements, one should not get carried away. Keep in mind, there's no moves are linear. Okay, one has to optimize. This is a larger picture which is looking at, and hence stock rotation, sector rotation, one should play. And this is something what we do at Quant Mutual Fund reasonably well.
Right. Sandeep, hi. It's also Samina joining in. So how do you now allocate incremental money that is coming in? Do you feel like this correction is going to be a slow, grinding one that will test the most optimistic bull? Or do you think over the course of the next 6 to 8 weeks, we may have a few days where the correction will be sharp and very swift?
It is very difficult to predict these things, how consolidation will happen. Since we as a house, we always say we are analytic driven and data driven. Okay, when data points change, we will change our stand. But as of now, if you ask me, the market has potential to correct and consolidate more before you see a sharp reversal in the market. But India macro, on absolute basis, I can say yes. It is expected that second half of 2024 will be relatively weak. But as we cross now the second half, maybe we enter into 25 or 25-26 cycle, then people start looking 2 years forward. Then market becomes again attractive. It's not be that expensive as you was looking at because there was slowdown in the earning this year. But what is very important for us to understand that is that for a longer term perspective, medium-term perspective, India is very constructive. So one should look for a buying opportunity rather than for any retail investor or any masses type of people whom I'm referring. Definitely is a buying opportunity which will emerge if any meaningful correction happen, and nobody can really pinpoint. I can only say that it's a risk-off period for us, and risk-off period we always play on back foot, play through large cap names, play through liquid names rather than playing through illiquid route, which has been working very well for last many years.
Absolutely right. And I read an article where you said you've actually actively moved away from illiquid stocks to liquid stocks because you have been sensing that uncertainty and difficult time ahead, which, as we see, unfortunately, is playing out right now. But I'm sure at the same time, this team is studying opportunities all the time, right? If not today, but over the course of the next couple of months, or maybe another 5 to 8, maybe 10% dip from current levels, or if there's any consolidation, what is it that you'd go out and buy? Would you buy banks? Would you buy consumption? Would you buy pharma? I mean, it's an open playing field for you, right?
So if you recollect, we have raised cash right from July, August in a big manner. And we were sitting on the beginning of October, also very substantial cash across all the schemes and particularly mid and small. In this recent fall, we are actually buyer in the market. Okay, we have deployed another 4-5% in the market. And if the fall is anything for whatever reason is meaningful, we will be aggressive buyer at these levels. That's a point number one. Point number two, what we're going to buy. Let's understand that. Okay. So if something has changed, okay, in India, it means the easy phase is over, which means I will still not going to venture out in the high beta names. I will still like to buy a mega caps company from the timing and then see how it changes. So again, same thesis. Let's remain slightly more defensive approach in our portfolio, low beta names, highly liquid names, large cap or mega caps name. So our portfolio strategy revolves around these things because ultimately as a mutual fund, what is our responsibility? Responsibility or mandate is to give superior risk adjusted returns. When we're seeing the risk basket or risk parameters are changing, and hence your approach towards money management or the way of your portfolio construction should also change. So time being, a defensive approach, a conservative approach, that's our thing. Look at last 4 years, we were very aggressive. See, when it's a risk on, in risk on period, which you can generate extra alpha, which helps you in a difficult time. In risk off period, the whole objective is just to protect the capital. That's a time you don't have to venturing out and be very aggressive. That can be challenging or maybe suicidal sometime when you see a risk off period and then you try to cover up your underperformance and you try to play in the front foot. That will not work. So based on whatever adaptive asset allocation thesis we look at, given the prevailing global macro, we would like to play safe. We don't want to showcase any aggression, even if market corrects and then recovers. Our thesis has not changed as of now, unless it becomes a completely risk-on environment, which is, I'm not ruling out. We are expecting that maybe post-US election, I expect risk-on rally. The potential of risk-on rally can come back. Maybe the crude can spike, Bitcoin can spike. There are not many data points which you look at. This metal cycle, which has seen some amount of correction, can they come back in the market in a big way? We'll see. Since we are slave of data, if it changes, we look into it based, if you ask me what is the data points is showcasing, there's a high probability because it's a bigger event which is playing out globally. The US election is a very big event. And post that event, we will evaluate how things look from the macro perspective.
Sandeep, so 3 buckets, right? You are largely into the defensive liquid large caps. You've been sitting on a bit of cash as well, but you have a very well-performing quant small cap fund, which can't get into large cap. So let's assume you sat on a bit of cash, but you also chose to sit on some themes, which you believe will probably correct less, or earnings growth might be there, which might help these sectors perform. I would love to know what are those, because large caps is probably the easier answer. From you, I want, where is it that you have high conviction in the non-large cap arena?
So Niraj, in terms of law, if you really sit down and analyze our small cap portfolio, which is in public domain as of last month, what is our focus area? Our focus area, obviously, yes, we have to have 65% minimum requirement as per set on the small cap, which we are maintaining. But remaining 35 is skewed towards either cash or is skewed towards a large cap. Okay, we don't have even mid caps also in our portfolio. But in terms of sector, if you look at, we still like consumption as a theme, particularly the food-related companies. So you have seen a couple of names in our portfolio. We still like larger infra themes, okay, or logistic company. They are part of our portfolio, the small cap. We like some of the smaller banks was compared to larger banks. So two smaller banks is there in our portfolio and a sizable exposure we have. We like some of the insurance names, so the smaller exposure towards insurance sector is also there. And we like second line pharmaceutical companies, okay, or the healthcare space, okay, or hospitality space. Those are the area our portfolio has been focusing. And I think the skewness is quite visible if you analyze our portfolio. This obviously is the area. But the most important aspect you have to understand, Niraj, is that in our small cap portfolio also, our portfolio is fairly liquid. Okay, some of the banks we talked about, it's very easy to sell. The telecom exposure which we have in our portfolio, very easy to sell, or the energy exposure, very easy to sell. So that aspect we have kept in mind. It's not about that you are facing redemptions or is a bigger crisis. No, it's a mindset. Okay, when environment is tough and your portfolio is very liquid, it gives me huge agility. At right time, I can switch from low beta to high beta names and catch up in a big way. The cycle is right. But if you have illiquidity in your portfolio, the switching games becomes very difficult. And that's something very important. The moment we saw the impact cost in the market is rising, okay, has a potential to rise further, we change our strategy, move from illiquid to liquid, move from high beta to low beta, and within the large cap also. That's the approach we have taken. So our portfolio in a small cap is very, very skewed towards some of the thesis which we like. And a lot of people question this, are you negative on the small cap? You're cautious on the market. No, we are not at all negative on the small cap. In fact, we are extremely bullish on the small cap. But one has to understand, if I'm bullish on Indian and small cap and the nano caps company will grow to the next level. But what is very important to understand and reassess your risk appetite, and second important, tenure, because typically every investor at the peak of the cycle, his or her risk appetite will be very high and everybody will give you a lecture of long term. The market corrects 6 months or 3 months, within a quarter, the tolerance level is not there. The long term becomes very medium term or short term. Right. So that's the approach we have to. If you are a long term investor, have a good risk appetite, the small cap is the area which should remain invested.
Just Sandeep, the bullishness on small cap, nevertheless, we have to put it into context of what we're seeing right now. And the first rush of earnings is something that the street has been a bit disappointed on. Perhaps other factors have made the tolerance level a little lower. How are you feeling about the numbers you've seen so far?
So definitely it is on, I will not say it is, obviously whenever you see a huge negative surprise, the impact you saw in one of the stock yesterday was very sharp because it was not expected, and the expectation, that's one of the reason at Quant Mutual Fund, we don't look at the forward. You think
overdone, Sandeep, Bajaj Auto? Do you think it was?
I will not comment on individual stocks, but I think expectation was, or some sort of hype got built. And when the hype is shaken or shattered, then you see such reaction. What is more important to understand, it is not like it's a big surprise, because most of the analysts have indicated, and as a house we know the second quarter or the second half of current calendar year will be weak. So it's not that we are very surprised and shocked what has happened. It is on expected lines largely. Some positive or some negative surprise could be there. But what is very important to understand that the negative surprise you are actually seeing in most of the largest company in India. But some of the smaller names and smaller mid caps or small caps, I don't see this is a trend. In fact, it is a very case by case thing, stock is specific thing. Some of the small and mid, and I will say most of the mid and small will deliver better returns than related to large cap. But what we have to see, up to what extent this is being factored in the price or not, that is the big debate one can have.
Sandeep, just one quick question, and this is the belief we all believe, right? Be greedy when everybody else is nervous. And I think everyone is nervous right now. What is your advice going out to retail investors that invest in your fund? There's so much talk about, upfronting STPs, maybe doing a little bit of a lump sum. If one has to do that and is seeking advice, what is it that you will tell them? Where should you increase allocation to? Which fund of yours? Should it be a flexi cap? Should it be a large cap focus fund? Should it be mid and small? Because those have been phenomenal outperformers. And I think you're one of those few fund houses that has managed to create significant alpha, while other fund managers, unfortunately, have struggled to even beat the index. So where would you up the game for or tell your investors to?
Okay. So the important thing, what we are saying, that if we believe that India is a long-term and medium-term very constructive approach and buy on dip strategy. So first of all, one should continue your SIP. I don't see any changes are there in terms of, because and I think this time retail is even more confident than the money manager and the distributor, because they have seen their M2M gains in last many has been very meaningful. I think it's a cultural shift now where investment is a part of their journey, rather than sometime it was people used to do it only in the FD and this was like venturing out in the stock market. I think that mindset has changed. People have understand the importance of how wealth can be created through long-term investment thesis, which has played out well. So one, obviously SIP continue. Second most important aspect is that everybody has to assess their risk appetite, their investment tenure. Once you get convinced that you are long-term player, then obviously small mid is the best option for you. But if you are convinced that you are not that 10-year or 5-year investor, though you felt so initially, then I think in the current context, flexi caps are the good strategy, because it gives me as a money manager one of the highest flexibility to shift between mid and large and small cap depending on the risk of environment. That's a good product which we like. But Quant Flexi Cap is another product which we really. Another thing I also want to share with you, we also have some product. So let's say every mutual fund launch product, from keeping in mind everything is long term, but investor has long term, short term, and medium term needs. So we have very interesting product called Quant Fundamental Fund, though it's a quant based fund. But the way we have created the positioning that money manager invests their money or allocation is based on the 6 months perspective only, the 2 quarters, where investor can be longer term. But in here, money manager has pressure to identify the stocks which has potential to deliver in 6 months period. So this is the where in the current context, when your market is very range bound or consolidating, this type of product which has a very short term or medium term approach, and it basically what it means, it prune down or bring down your risk level also, because in the environment which something has changed, it really helps. Okay, so it's a very interesting product. Let's say in 2022, okay, when calendar year 2022, when majority of the schemes have delivered negative returns, Quant Fundamental has given highest return in the industry. It was 28% return. So it'll give you perspective when market was tough. Benchmark was giving negative return, they'll deliver 28%. And even in last 1 year, if I have to talk about, it's give you just more from an academic purpose. Okay, give you perspective. Typically, it's a large cap centric approach in the Quant Fundamental, but it has competed with the small cap. So it's a very interesting product which we have designed. Okay. If they ask me what you can look into it.
Yeah, no, absolutely. I mean, I think in tough times, then you leave it to the experts. But the fact is that a lot of people watching us right now, Sandeep, are keen to understand how you are viewing the current situation. And I think safe to say that there are some clouds there, but the long-term view continues to be positive. Thank you so much. Sandeep Tandon there speaking with us.
Thank you.
We'll take a very short break. But before we do, we talked a bit in that conversation with Sandeep Tandon about foreign investors. And he talked about how it was in the context of China. So foreign investors have sold over 71,000 crore rupees in October. But where are they buying the most and what are they selling the most? Chinmay is joining us with that data. Chinmay, the figure looks big. Foreign investors headed to the exit door, but what are they dumping?
Well, the FI selling so far this month has been the largest ever seen by Indian equities at 71,000 crores. This even crosses the figure that was seen during the COVID lows at the end of March 2020. The FI outflow stood at 62,400 odd crores. Now, for the full stretch where FPIs have been selling so far, it's been 14 sessions. FPIs have sold around 77,000 odd crores in Indian equities. During this time, it's DIs who have been buying at 75,000 crore worth of inflows. Now, a notable point there is mutual fund flows, which make up for a considerable amount of the inflows made by DIIs. As of September 30th, active equity schemes were sitting on a cash pile of 1.49 lakh crores. Now, when we look at what sectors FAIs have been selling in so far and buying in, first we have chemicals, where they've been buying about 500 odd crores worth of equities in October so far, followed by metals and mining stocks, and then utilities at 120 odd crores. For the sectors where there have been sellers, financial services comes up at the top, around 23,000 odd crores of selling, followed by oil and gas and consumable fuels, 12,300 odd crores sold, then automobiles and auto components, FMCG companies, and consumer services.
All right, welcome back. RBI seems to have walked the talk after warning NBFCs to adhere to norms a week ago. The regulator has barred 4 firms from disbursing loans. The NBFCs were found to be lending at high interest rates. That's not all. The RBI has also undertaken action against gold financing company Manappuram. Vishwanath Nair joins us for more. Vishy, can you recap all the action the RBI has taken overnight?
Yeah, Tamanna, just a clarification. So the action is against Asirvad Microfinance, which is a subsidiary of Manappuram Gold. And the reason why a lot of brokerages are against Manappuram is because Asirvad Microfinance contributes about 27% of the consolidated AUM at the Manappuram level. And that's why there's going to be a significant earnings impact, primarily because disbursals and sanctions of loans have been barred by the Reserve Bank of India. We have seen in the past that these kind of restrictions do affect businesses for a fairly long period of time, anywhere between 3 to 6 months, and sometimes extending to up to a year. And that's primarily why the RBI is so in its guidelines, and that's why we are seeing this kind of action against Manappuram Gold. There's also BM, MU, and now which is Satin Bansal's company. All of these have been impacted by the RBI's regulations, Arohan as well. These companies were, of course, lending at issue space, as you mentioned, but there's also some mention of evergreening of loans, some non-compliance with the RBI's asset classification norms. All of these are issues that the RBI takes very seriously, and that's what it has said. It has not specified which company is responsible for what, but there's clearly a lot that is happening in these companies which the RBI is not very happy with. If you remember, during the monetary policy announcement, the RBI governor did point out that they have been talking to NBFCs and they're not really happy with the growth at all costs sort of approach that some NBFCs are taking, and that compliance with guidelines is very, very important because that is intended to protect the end consumer. These are some of the actions that have been taken. Of course, everybody was a little curious to understand which specific NBFCs the RBI is talking about. Now you have 4 of them which have been subjected to action.
Okay, thank you for that. Vishwanath Nair there. So expect NBFCs under pressure. Manappuram, because of its subsidiary facing the brunt of RBI action, could be under pressure as well. But Kunal Rambia joining us now, as is Deepan Mehta, to talk about the markets today. Welcome to both of you. Deepan, great to have you on the show. Kunal, great to speak with you again. Kunal, I'll start with your view on the index. I mean, painful kind of a week it has been. Do you expect the pain points to continue? Implied Open also pointing out to quite a turbulent morning.
Very good morning to everyone. Thanks for having me on the show. So if you look at the Nifty levels, yeah, certainly there has been a significant sell-off, in fact, on the indices. But if you just go back and check out the data of August 2024, the level was somewhere near to 24,700. We saw the massive high, and again, this particular level or zone was tested almost 3 to 4 times so far. Yesterday's closing was 24,750 again. So if I look at the trend is certainly intact. The higher top, higher bottom still continues on the index, and we need to now watch out for today's closing. If the today's closing is lower than 24,700 to 750 zone, then yes, I expect a further correction of around 1,000 points on index. That's on Nifty. But if today, after gap down open, if we the Nifty is successful in claiming back this 24,750 zone, then I think the trend might just continue even from this level, and this can be a good buying opportunity. So as of now, for the day, it's a wait and watch situation, and the level to watch out is 24,750.
So, Kunal, if you get a close at under 24,750, I'm guessing at 315, one shouldn't execute a long trade, or are you saying that take a long trade and go into the weekend? Because the setup globally is also fairly uncertain. How does one play that?
Absolutely. So, in Indian indices, we have seen decoupling happening. Actually, Dow Jones is making new high, but the Nifty is not really moving in the same line. So I will not be really keen to initiate a buy over the weekend. But certainly if Nifty manages to reclaim this 24,750 on the closing basis, I'll wait for one more day. That's on Monday. And if there is a follow-through buying, then certainly I'll initiate a buy with today's low as a stop loss. Remember, the trend is very important, and on the lower time frame also, we need to wait for the higher top, higher bottom. So yes, I'll be on a sideline for the day. And if this level is reclaimed, as you rightly mentioned, we will wait for one more day, not carrying any position for the weekend, but certainly initiating a buy on Monday with a fresh follow-through buy.
Okay, let's quickly get your stocks, Kunal, for this morning.
So I'm very bullish on the couple of counters which have shown good momentum in the recent times. The first is the SW Solar. SW Solar is looking very attractive. The counter actually reclaimed the breakdown zone. So with the present level as the initiating level, I think with the stop loss of 575, one can initiate a buy on this counter. Buy on dip can also be a good strategy on this, and this target can be 675. The another two are the small banks which I'm looking at. The first is IOB, Indian Overseas Bank. Yesterday we saw very good momentum in this counter, and the trend on the weekly is still positive. So with the stop loss of 51, one can initiate a buy, and the positional target on this can be 65. And the third counter is the South Indian Bank. Post result, the counter showed very good momentum. Entire downtrend of last 3.5, 4 months is coming to an end. So with the stop loss of 23, one can initiate a buy, and the target can be 30. So these are the three counters to watch out from short to medium term.
Deepan also with us this morning. Deepan, great to have you on the show this morning, which is a rough morning. Let's start by the numbers and your take on the numbers that came in yesterday. Infosys, Wipro and Axis. Largely disappointed with what you saw on the IT side?
Good morning, Tamanna, and thank you for having me on your show. Yeah, very disappointed with large cap IT, whatever they've reported so far. And this has been a consistent pattern. We are hoping for revival in the revenues, but somehow quarter after quarter, they just keep pushing that guidance. And even going forward, I don't know, next 2-3 quarters, looking at the guidances given by the management, it doesn't appear to be a great year for large cap IT, maybe mid cap IT as well. And we have to just live with this kind of 4-5% type of a bottom line growth rate, which is not at all exciting and doesn't even fit the criteria of most investors who are looking for at least 15% earnings growth. So whatever gains we have seen in the IT stocks for the last 1 year or so is largely on account of expansion of price to earnings multiple, and that cannot go on forever. It is unsustainable given the low growth rates. So I would say that at opportune times one should look at lightening up positions in large cap IT. And software as a whole is becoming very difficult, very, very selective. The quality companies which are able to deliver the growth, they are trading at very rich P multiples. And the ones like, large cap IT, some of the other pure play software service companies, the growth is not there, but valuations are maybe reasonable in historical basis, but growth is just not coming.
Dipin, tech aside, everything else also seems to be having it quite tough. So earnings were subdued post-close yesterday. Apart from tech, we saw earnings from Tata Chemicals and CEAT. CEAT numbers were pretty dismal. Tata Chemicals also was seen a big cut, but they've done better or less bad than they have in the last few quarters. What is the outlook on Tata Chemicals and CEAT today?
I think both numbers were not up to our expectations. They are cyclical businesses, so you may see a comeback maybe 2-3 quarters down the line. CEAT tires, especially raw material prices, will correct. Then you may see improvement in operating profit margins. And with Tata Chemicals, there were certain challenges in terms of weather patterns, and certain markets did not perform well for Tata Chemicals. But look, I think in valuation perspective, they seem to be fairly valued. And one cannot go ahead and buy these companies based on these numbers. Once you see a further correction and perhaps it reaches that fair value to distress value zone, then maybe you could look at even these commodity stocks, but not at these valuations.
Okay, we'll take a very short break. On the other side, we focus on BFSI and Axis Bank numbers as well. We come back with pre-open rates. Are we going to have a rough morning? How do you navigate it? All of that on the other side.
Back with India Market Open right here on NDTV Profit. A clutch of results will be in focus today. And before we talk about the larger ones, I want to bring up a couple of mid-sized names to just try and understand what the impact could be like. Dipan Mehta and Kunal Rambia with us. Dipan, what did you make of, for example, the numbers of the tire companies, particularly CEAT and the way it's come out? Because revenues were up 8%, but margins have cracked. And this is a period of time when crude prices were benign, but rubber prices were moving up. So it's gotten hit, and the valuations haven't quite taken that hit. So could these stocks correct? CEAT, Apollo, the likes?
Yeah, good morning. Certainly, I think, nobody wants to buy into disappointing numbers, and one should expect a similar trend for other tire companies as well. So I would avoid the entire sector. At the same time, we are seeing slowdown in the auto industry, so OEM sales also may get impacted. And although transportation as a sector has a great long-term future, but I think we are entering into a zone of mild, I would say, mild slowdown in demand across the board, across many products in India. And maybe the markets are starting to factor in with the kind of correction which we have seen. But these kind of numbers coming in from CEAT, I would be a bit cautious on the entire sector.
What about you? How would you play some of these tire companies? They've had good days when crude prices ease off, but of course earnings are disappointing, and I'd imagine CEAT's impact will be felt on every tire company. If any of them open flat this morning, would you go short?
So if I look at the trend again, I give a lot of importance to the trend. So if I look at the trend, I'm still absolutely okay looking at, the buying side of the market. The best counter which I like at this point in time technically is Apollo Tires. It has not done much, but it's near to the support as of now. So if the counter manages to stay above 495, I'll think of initiating a buy. But by any chance, if the counter falls below 485, 490, then yeah, I'll think of shorting that counter first. But more or less, the trend looks as of now positive.
The other set of stocks wherein the rumor came in yesterday, and the City Note highlighted that the gas companies could see the administered price APM gas quantities being reduced. Now, yesterday the stocks corrected a bit. Now it's officially out, 20%, 21%, 20% and 19% for IGL, MGL and Adani Total Gas. And very likely that these stocks could see a further hit. Look at IGL. Looks like it's starting off on a very weak footing as well. Quick chart check first there, Kunal. Can these stocks go further down?
Absolutely, Niraj. By now, this breakdown actually happened on 14th October itself when the counter was down by 4%, and it came out of sideways consolidation of almost last 3 to 4 months. And yesterday was a follow-through. Now, this was the confirmation of initiating the shorts with the stop loss of 515. Now at today's gap down, I will not really be keen to initiate any trades because of unfavorable risk-reward ratio. But if someone is holding, then we can expect the first target to be 475 and below that 465.
Fundamentally, if such a hit comes in and the companies have said that this is very negative for the profitability, again, I know people won't go out and buy it today, but do these become accumulation candidates at lower levels, or are there better plays out there? The question is to you. IGL, MGL, Adani Total Gas and the others.
Okay. No, I think that these are utility companies end of the day. And there was few years ago, people were very positive, including us, because it was more and more application of gas was taking place. But look, EVs are the future, and whatever upsides these companies are going to get from CNG and providing other similar fuels, those upsides seem to be a bit dicey at this point of time. So I'd be a bit cautious on the entire sector. I don't think volumes are shaping up as well as we thought 2-3 years ago. And it's better to move on away from such utility companies. In any case, there's a lot of government interference, as I heard you say that the APM prices have been moved lower. So that certainly affects the prospects of these companies. And valuation may be decent, even yield also may be good. But from an investor's perspective, we want growth. And I don't see growth coming through in these gas distribution companies.
All right, just let's take a look at some of the action in the pre-open session. Manappuram Finance, as expected, taking it on the chin, 10% down right now. Result impact is the other theme that you're seeing. Havells about 6% down and getting hit quite hard. Tata Chem not doing too badly. at this point. So Tata Chem is okay, about 0.5% up right now. Gas companies taking it to the chin. Gujarat Gas, we talked about MGL, IGL, all of them. Zomato is the other one, 3% down in the pre-open session. They're going in for a QIP. So that fundraise just in the very initial moments, and of course all of this will settle, looking a bit negative. But we're talking about Manappuram and the big brokerage call this morning coming in from Harsh. Harsh, brokerages called it on Manappuram Finance. Quite a big hit seen there due to RBI action.
Huge, Tamanna. And just to kind of quantify the viewpoint from the analyst perspective, Morgan Stanley has reduced the target price from 262 to 170, which is from a huge upside. It's actually a downside of 4% now that they see on the stock. They've downgraded to equal weight. 177 was the price yesterday at close, of course, reflecting that 10% lower price at the moment as we speak. First off, RBI embargo to hurt profit materially is what Morgan Stanley says. Shorter tenured loan book, and therefore the shrink on the loan book will be very sharp. They're also saying credit costs will continue to remain elevated, and they've cut consolidated earning forecasts for FY25 by 20% and 30% across FY26 and 27. They're valuing this now at 1 times price to book FY27. JP Morgan too, they believe that it's a huge setback. Disbursements will start getting impacted. Capital infusion will be the key risk, and that will be required according to JP Morgan. Asirvad is 27% of Manappuram's book, they highlight, and therefore risk in terms of asset impairment is higher in this book. 27% of the book, higher asset impairment, and credit rating therefore likely to get impacted. They've downgraded to an underweight, JP Morgan. Jefferies has also downgraded, target price 167 for Jefferies. They believe that restrictions on the subsidiary is going to hurt earnings. They believe the parent may have to again infuse capital. Remedial measures required. They've cut EPS estimates by 11 to 20% or 19% between FY25 to 27. So not looking good at all, even from where analysts are viewing this.
Down in pre-open trade, that's what we have on Manappuram. Wipro, interestingly, is trading flat, so it's not looking too bad in pre-open, and so is Infi. So despite the fact that the ADR sold off in trade, our market's not being too harsh on these IT names that reported numbers. Tata Chemicals was the other one that posted numbers. I think the focus this morning, okay, no, Infi is down 3%, so it is showing the same weakness it has. Tata Chem down 2%, CEAT should be weaker. Metals may see some sort of a trade this morning, but it doesn't seem like we are going to find too much to hold on to in today's day of trade. Bank Nifty will be critical as well to see if there is any sort of trend emerging there in today's session. Kunal, would you be looking to trade any banks this morning?
Absolutely. As I discussed in the beginning itself, I'm looking at two small banks. The first is IOB, Indian Overseas Bank, though it's not part of index, obviously. And the second is South Indian Bank. These two banks are looking very good. Apart from these two, I think I'm getting very good risk-reward ratio in ICICI Bank. The trend which I'm referring to for ICICI is from the bottom of 2020 till 2024. It's right onto the support. So if this counter manages to hold the levels of 1210, I think one can initiate a buy, and the targets again. Let's not keep the targets because it's a trending counter. But yeah, for the short term, the targets can be 1300 again. So out of the private sector bank, I'm keen on ICICI, and the small banks are IOB and the central bank. The South Indian Bank.
Also, a quick one. After 4 days of heavy selling that auto stocks have seen, would you play the auto sector, the auto index or auto stocks for a recovery today, even if it is short and short-lived? Any of those counters look good to buy this morning if they open flat?
See, again, if you look at the Maruti's performance of from March 2024 so far, the counter is just been in sideways consolidating, and this support, which I can see on the chart, is 12,000 levels, and on the higher side, the resistance is 13,000. This is, mind you, sixth trade within this last 7 to 8 months, 6 months, where we are getting this 1,000 points rally again. So by any chance, if I get the opportunity to buy Maruti near 12,100 kind of levels, which is actually the current market price, with the stop loss of 12,000 on the closing basis, one can initiate a buy, and the trade and the targets can be 13,000. But this is the only counter which I'm looking at for trade because of good risk reward ratio and consolidation.
Okay, just want to get Deepan's take on some of the action we're seeing this morning on banks. Axis, Kotak Mahindra, not too bad in your pre-open session. Do you think some glimmer of hope there, Deepan, even as IT might have it rough?
I think from a large cap perspective, it's better to be overweight banks. We have seen a mild turnaround over there. At least the big banks have stopped correcting the way they were. And maybe the worst is behind them in terms of performance also. So I think investor interest may come back in large cap banks. But the real action, is as Kunal was saying, is in these small cap banks, Central Bank of India, IOB, Bank of Maharashtra. And, you look at the way the numbers are coming from the tier 2 PSU banks and you compare them with the large cap private sector banks, you hardly see any difference in terms of their earnings quality or earnings growth. And the tier 2 PSU banks are trading at single digit price to earnings multiple, slight premium to their book value. So I would sense that these are the companies where you will get the alpha, the tier 2 PSU banks. That's where you may get the alpha as compared to some of the larger private sector banks. But one thing I'm pretty certain that banks are gradually getting back into leadership position, and you will see more money flowing into them. This is one sector where valuations are still not completely out of whack, and earnings are steady, if not improving. And this is true for a lot of other tier 2 private sector banks also. I saw Karur Vyasa's numbers were pretty impressive, and pre-quarter releases which came from RBL and IDFC first also are quite encouraging, I would say. So one can be selective in the bank NBFC space and look for good opportunities. That is one segment which may outperform even in a correcting market.
The other sector, of course, will be tech. And Rucha is joining us with what the key verdict of the street or the brokerage community has been on the two earnings that have come out. Rucha, good morning.
Thanks. Good morning, Niraj. So let's talk about Infosys. Well, we have a bull case on Infosys with Bernstein maintaining an outperform with a target price of 2,270 rupees, upside of 15%. Now, revenue was a beat, margin in line, guidance upgradation is all what we know. But what the brokerage house says that Infosys is expected to be the growth leader, largely driven by the improved macro and improved discretionary spends and BFSI. Now, remember that Infosys has a large part of its portfolio coming from the discretionary spends. So revival in discretionary spends will benefit Infosys the most. Infosys has also maintained leadership at 2.3% QOQ organic revenue growth. It also grew ahead of TCS and HCL Technology. So Bernstein very bullish on Infosys, but Citi still is bearish on Infosys, maintaining a sell rating, target price of 1965 with a downside of just 0.5%. Now, though it reported a decent quarter, the brokerage house says that Infosys has already run up 40% over the last 6 months, and therefore some near-term correction cannot be ruled out. However, in terms of TCS and Infosys, well, it prefers Infosys over TCS, and it also has a sell on TCS. Though in terms of the IT sector as a whole, it expects a modest and gradual recovery. Forward-looking indicators are still sluggish for most companies, and it will wait for any triggers to happen at a global level. It expects Infosys to be better than the peers, but in terms of large and mid and small caps, it definitely prefers large caps over small and mid.
Thank you for that, Richard. That's, of course, tech and what the brokerages think of those earnings. Zomato is looking a little rough this morning. Dipin, do you track Zomato? It's their third fundraise in the last 4 months. They're already sitting on significant cash. We know that Swiggy is coming around on the markets in the next 6 to 12 months. Do you feel like this is prepping up for some cash burn maybe down the line or something big coming?
Yeah, well, I don't know why they are raising a QIP. Maybe it could be taking advantage of the opportunity and just raising your cash reserves so that whenever the emerging competition comes, they can take on the competition in a sustainable manner. But look, I think markets will absorb this news flow from Zomato as well, purely because there is growth and there is renewed confidence that the quick commerce business is doing extremely well for Zomato, and it could be a really growth engine going forward. So I think investors will lap up the Zomato QIP although I'm as a shareholder and a measure of disclosure, we and our clients are invested, I'm not completely in sync with the management's effort to raise QIP at these levels.
That, Deepan?
Sorry, can you repeat the question?
I'm saying, why is that? You're saying you're not in sync with the management's efforts to raise QIP at this level. Why is that?
See, any equity dilution is not in favor of minority shareholders. That's point one. And secondly, you already have a lot of cash on your books. So keeping that in mind, why do you want to raise more cash? Because at the end of the day, the returns ratios do get diluted because of excessive cash on the balance sheet.
It's a tough one, and I think Zomato has found its rhythm after last quarter reporting. So it's sort of counterintuitive of why they're doing what they're doing. The stock is down 5% in trade, will get lapped up, but that is besides the point. Technically, Kunal, do you track Zomato? It's pretty much at a one-way journey from 160 last 3-4 months ago. At 255, 260, it's off those levels of 270, 280. So it's a good sort of point right in between of the recent rally. A long trade on Zomato recommended, you think?
So, so let's look at the little longer chart from Jan 2023 so far, when the counter was trading at 45. Now it's at 255. The trend is absolutely positive. But the only missing point is that from August 2024 so far, that's been almost 3 months now, the counter is missing out on the momentum. Trend is absolutely positive, undoubtedly very strong. So with the stop of 240, one can think of initiating a buy. This decline can be a good opportunity to ride the rally. But if the counter breaks 240 level on the closing basis, I would advise an exit.
Okay, 14 seconds left for the markets to kickstart trade. We'll have a rough ride on open because a lot of specific pockets will be under a bit of stress today. So bear that in mind. But let's see what the market-wide levels open up like, because we are close to those support levels. But certainly we'll start off lower. But here are the first trades. We're about 1/3%, 74 odd points. So 24,670. We are below 24,700. 24,700, 750 is where the market has found support. Let's see if it actually recovers today or no. Banks are doing okay. So suffice to say, IT is having the rough ride. I would reckon mid-caps and small caps too should be getting punished. Yes, indeed. 0.65% lower for the mid-caps. Small caps about 0.8%. Let's get the heat map up on the screen. Let's see the IT names here. Infosys down 2.7%. Despite the upper end of the guidance being raised. Maruti down, Lawrence Barranco flags out a risk to that one. Bajaj Auto down, M&M down, so autos continue to get hit. Shriram Finance has gotten hit as well, SBI Life amongst others. A fair degree of red, with Reliance marginally in the red too. Now what about the greens? Axis Bank 2.5% higher. So the reported PAT numbers being liked by the street. Eicher Motors, a lone star of sorts on the auto pack. Wipro seeing a bit of an uptick out there on Q2 performance, even if the Q3 guidance was weak, and maybe the bonus too. Sun Pharma, Bharti, ITC make up the rest, but there's a bit of a defensive bent, and the quantum of red has enveloped the screen now in a meaningful way, because we are now down 0.5%, 24,640. Forget 24,750. We are below 24,650 as well.
Painful morning to say the least. NBFCs are going to be one sector which is hurting. Maybe that's why you're seeing Shriram Finance like that. Let's pull up the sectoral cues before we get to specific stocks. And while results could be one part of it, this is bigger. This is a bit of concern and panic seeping in. Small cap is the biggest loser. It's Nifty, IT, Realty, all of them. Auto, Realty, IT, all of them feeling the heat today. Some semblance of green on the private bank side, but that's largely an Axis and a Kotak Mahindra more than anything else. So not too much relief here, and that's very clear from this chart. Let's pull up specific stocks. Let's look at result impact. So Tata Chemicals, Polycab, LTI Mindtree, Prestige. Some companies which declared results. The top line ones have of course been covered on the Nifty, and you saw what happened with Infosys, Wipro and Axis. But here the picture is not pretty at all. Tata Chemicals 2.5% down. Polycab really taking a hit, 6% down this morning. LTI Mindtree, Prestige, all of them in the red. So this is one big worry for the markets right now. Companies are not performing as per the stock run-up that we have seen. Valuations is beginning to become a problem. The impact of gas changes. Administered price gas will be now given in smaller quantities to companies, 20% cut there. Today, the impact is really hurting. We told you about this yesterday on NDTV Profit. IGL down 8% this morning. MGL, Gujarat Gas, all of them hurting. Zomato is the other one. Not too many greens to talk about, unfortunately, this morning. Fundraise plans have not been taken too kindly to the street. Remember, we were at a time in this market just a few months ago where a QIP was seen as a positive, but this is logically what you should possibly be seeing happening because equity dilution coming in 3.5% down. Manappuram Finance was 10% down in the pre-open session, and that's where it stays. So that pain point continues. I don't know if you're spotting any green. Samina, I had a tough time looking for stocks that are moving upward.
Full of those, but just to add to sadly your selling list, tire companies are not enjoying what they've seen on CEAT. So CEAT itself is down 5.5%. Along with it, the rest of the tire companies or the tire pack is trading much lower. KEI Industry, third straight day running post its earnings, it's seen pressure on the stock. Today is no different, another 3.5% gone on KEI Industries. Metals not doing great either. Jindal Steel is down 3.5%. You've got stocks like IFCI trading weak. Railway counters were in a good space all through Monday, Tuesday, and maybe partly on Wednesday. Today, of course, is a different story. Your rail counters also seeing some pressure in trade. Tata Chemical numbers, I don't know how we should look at it because they were really bad, but they were less bad than what we've seen in the last few quarters. And I guess that's how the market's also responding to it. 2.5% cut on Tata Chemicals is what we have. Well, apart from that, 361 WAM is seeing some pressure. Nuvama is looking good. So all that capital market play that was a little bit of a theme for a day or two this week is back in the red, seeing some profits being taken off the table. Remember, we are going to the weekend, so traders may not want to take too many aggressive bets or positions, even if there is all this talk about decoupling of India versus the rest of the world. You just want to be careful and cautious, and that's probably why some of the stocks that gained this week are seeing profits being taken, HDFC, AMC being another one. On the gaining side, Mazagon Docks is looking good. I don't know what is happening here, 2.5% higher. Take a look at Cochin Shipyard. They concluded their OFS yesterday. The stock still down 2.5% as we see it. Wipro, Axis are the few gainers. You've got Aisha Motors that's looking good. Alchem Laboratories is trading higher. Pharma is not doing too badly in trade. So there are some pharma counters that are marginally in positive territory and the others that are trying to turn positive as we see it. Dr. Lal Path Labs is positive. Kalpatru Projects looks okay. TCS is seeing a flat start. So, and I don't know, Wipro numbers were not great, but the stock is looking really good. 552 back on Wipro on a bad market.
On Wipro, your revenue quarter on quarter, constant currency was highest in 7 quarters. Your deal wins was highest in 10 quarters.
I don't know how much the market
but you're coming out and saying that there's going to be no growth going ahead. The upper end of my guidance is 0%.
There's also a bonus element to
That's
it.
all the issue.
So which was priced in. But
yeah,
yes,
but
maybe.
Maybe. 1:1 is not a bad number.
I don't think, so I think it's a bonus issue that's driving Wipro. Earnings
Dipen would know this well.
Yeah, Dipen, what do you think? What is going on? I mean, Wipro back at 542. We haven't seen that number on the screen since September. And it was also, for whatever it's worth, it's the only one that, traded flat when tech stocks were falling off on anticipation maybe of this bonus issue that's come in after 2019. And even this morning, it's holding up and it's holding really well. Almost 545 for 547 on Wipro. You think it's the bonus? You think it's the fact that they may be turning around the corner, but they haven't done it so far, so I don't know.
Well, difficult to say why a stock would go up 2% in a single day on very tepid numbers and even, I would say, disappointing guidance. It's just that it is cheap compared to its peer group, and we may see some money flowing out from the likes of TCS, Infosys, HCL Tech into Wipro. Just like a clear, I would say, earnings multiple arbitrage may be taking place over here. And bonus may have certainly improved the sentiment in the stock. But look, these are, one has to buy growth stocks, and as of now, there is no growth in these companies. So I would not, look at trading in these stocks just because of a bonus or because of the stocks being cheap compared to their peer groups. I would still avoid large cap IT.
Another one that I want to quickly highlight and just take a look at how Tamanna is doing in market open right now. The stock is your fourth biggest loser on the 500 counters that we have, 6% lower on Tamanna. If we can just quickly take a look at how the earnings have been. Markets may not be too pleased with what they've seen on Tanla platforms. Revenues were flat. EBITDA was up 20%. Margins have also improved significantly. And net profit is up 8%. But the counter is seeing a 6% cut. Dipin, it's a very small stock. But, I mean, I don't know what ever goes on with this one. Do you agree? It's a little bit of a punt play in so many ways.
The first disclosure, we are invested in Tanla platforms, and the results certainly are disappointing, but they are bearing the brunt of this Vodafone International deal, where revenues are not coming through from that particular arrangement. So that is impacting, and also I think there are some very strong structural headwinds for the CPaaS business while they transition into the OTT business, OTT flows, which are basically from WhatsApp and other related platforms. So there is some kind of a churn happening as far as the revenues are concerned, but we remain invested because stock is reasonably valued. And end of the day, you do require these kind of services. And the digital volume is certainly growing for the entire economy globally and in India. So company like Tanla platforms will always have a role to play. So maybe this is just 1 or 2 soft quarters and we will see growth coming back. But on the whole, I think one needs to be a bit cautious and just wait and watch, and then look at how the eventual scenario works out for not just Tanla, but there's Root Mobile also, and one could expect some disappointment over there as well.
Sorry, the other one which is really getting hammered today, guys, is Quick Heal. And I was just pulling up the numbers, and with reason, because while just looking at YOI numbers, while they've maintained their revenues, the profitability has gone down quite dramatically from what it was. It's a 66% drop in profit after tax YOY. Maybe that explains the 9% dip out there. So mid-cap, small-cap certainly coming under a bit of a hammer, and a lot of those result boys really out there. So actually, Kunal, some charts there, 2 or 3, pick up any one. One is Quick Heal, of course. One is Tanla. Let's put in a Tata Chemicals and a CEAT there too. Pick one of the 4 where the charts look slightly wobbly, even from these levels.
See, Niraj bhai, if I look at Quick Heal chart, it's absolutely trending counter. June 2024 low is 395, right now 695, and the clear higher top, higher bottom is seen even on the daily chart. So by any chance, if the counter manages to come near 645, 650, I think one can initiate a buy on Quick Heal. I was just watching at the Tanla's chart. Now this is a sideways consolidating counter since almost 18 months. The range is broadly 800 to 1150. Right now, it's near to 800 again. So as you know, we give a lot of importance to the previous levels on the technical front. So near 800, by any chance, if the counter gets into a sideways consolidation near the zone of 800, one can definitely think of initiating a buy. But if the counter falls below 800, then I think 650 to 700 can also be seen. If I come to Tata Chemicals quickly, now it's again absolutely sideways consolidating counter since March 24. The support is 1030 and the resistance is 1200. Counter is near to 1030. Needless to say, one can think of initiating a buy with the stop loss of 1025. And the targets can again be 1200. These are sideways consolidating counter, a lot of comfort given because the ready supports and the resistance are available. So as a trader, I will always prefer these counters.
Polycab is the other one that's hurting today. So numbers have disappointed. FII flows is a concern. And now valuations comes back into play. Deepan, we've talked about what's not working. Let's talk about what a constructive outlook could look like right now. You mentioned earlier about private banks. Is that the only silver lining you're seeing? Or are there more stocks that you would look at right now?
No, I think pharma could be an interesting place also to be overweight in. We are seeing improved numbers last 2-3 quarters, and the risk from any FDA regulatory action certainly have reduced. Compliance is far better. Many new registrations have taken place for a lot of pharma companies. Those revenues should start to come in. And the kind of intense price correction and price erosion we have seen, there is some semblance of reasonableness over there as well. So I feel that pharma may also outperform in this particular earnings season. Looking forward to good numbers coming, not just from large cap pharma, but also a lot of mid cap pharma companies should do exceptionally well. And valuations are slightly higher than their historical averages, but I think numbers will surprise us on the upside.
Right, that's how you have some of those counters trading in trade. Kunal, anything you've identified for an intraday pick, either on the long or short side?
So the counter which I like the most at this point in time is Mastech. Now this company is about to come up with the result in a day or two something. But I think this counter which is showing good trend since 8th October till 18th October. Look at the levels from 2600 to almost 3000 levels. I think this trend might just continue as well today. So with the stop loss of around 2900, one can initiate a buy and the targets can be 3100 to 3150. But overall, I'm very bullish on Mastech even from positional point of view.
Are you finding a trading opportunity here? Because I know it's tough to call it because one day when they go up, then there's no follow-on buying. It's literally a buy today, sell tomorrow trade every day on metals.
So on metals, again, if I just look at, say, Hindalco itself, it's sideways consolidating. So the immediate resistance is 741. With that, one can initiate the short and the targets can be 715. But think of buying near, again, 715 because of sideways consolidation. It's a very short-term trade.
Dipan, quickly, 30-second answer before we get to Polycab. But just you're not in the buying mode as yet, right? I know you were negative. You're still not getting into buying, I presume. 30 seconds.
Sure.
Yeah.
I won't take even 5 seconds more to say.
Okay, Dipan. We'll leave it at that. Thanks so much for taking the time out and being with us. Great to get your views. Kunal, just stay on your one view on Polycab. But before that, let me get in my colleague Mahima, who joins us to tell us about the reason why Polycab is getting hammered in trade. Mahima, the revenue growth was strong. So what has disappointed the street?
Well, Niraj, in terms of margins have taken a significant hit from that 14.4% mark to 11.5% mark, which has probably disappointed the streets. Now, a couple of reasons why margin contraction has taken place. First one being higher mix of B2B and institutional sales. Second being lower mix of exports. Third one, they continue to invest in category and brand building efforts, which is why also margins have taken a hit. And lastly, management has stated that intense competition is also impacting the overall PAT. Now, in terms of margin history also, if we check, FY24 had a 14% margin, FY23 had a 13% margin, and FY22 had around a 10% margin, and few quarters had around 12% margin. So it has gone back to the levels where it was at FY22, which is why the street is not viewing it very well. In terms of export is their highest margin segment, and export revenue has declined around 29%. And this is why margins, this is also one of the major reasons why margins have taken a hit. In terms of stock performance, well, the stock has not done much in the past 6 months. It's up around 26%. 1 year also, it's been up only around 25%.
Right, Mahima, thanks for that. That is the story of Polycab, down 6.5%. You know what is absolutely shocking is Wipro, nearly 5% higher in trade right now. It's back at 553 is what we have. So there's no stopping this one. It started off well, but it's at the day's high point in terms of Wipro. Is what we are getting in. Along with that, you've got a few of the other counters that look okay. Kunal, very quickly, if you're buying strength, would you buy Wipro right now at 552, 553?
Absolutely. The second you mentioned 555, my alert got triggered. The only reason being this counter is now coming out of sideways consolidation of 2 months. And the resistance was 555. And right now on the screen, we can see that level itself. So with the stop loss of 530, one can initiate a buy and the targets can be 575. Keep trailing the stop loss because it's a trending counter on the weekly chart since October 2023. So I will definitely trail this and I can expect, the levels of around 600 to 625 also.
Okay, let's have a very interesting conversation right now. Kunal, thank you so much for speaking with us. Manav
Pleasure.
Chopra is joining us now, Director Technical Analyst at Nuvama Institutional Equities. And I can't think of a better day to have spoken with you, Manav, because you've put out a report focusing on small and medium sector, small and medium stocks, mid stocks, and they are the ones really taking it to the chin today. Let's start with the context. And before we get to the details of your report, let's start with setting the context of why we are seeing so much pain in the broader markets. What, in your view, are the key concerns and worries?
So what we've seen over the period of time when we're looking at the long-term scales, see the markets, definitely we are in a larger bull market scenarios, but there comes a phase where the market reaches to one of its extremes, and it's unlikely that the market moves higher. And we haven't seen any major returns or the positive returns coming from that side. So starting from since July or mid-July, we've seen the breadth of the markets. We have seen a significant amount of decline in breadth since July. As the mid caps and the small caps continue to make new highs, the breadth started deteriorating. And one of our proprietary indicators of identifying the extremes of the market also reached 95 percentile in the month of September. So, when the markets had witnessed a raging rally of 6 consecutive quarters without any breather, the breadth started deteriorating. We did witness some undercarpet correction already started to play in the month of July. And, when all these parameters started to come in and, certain pockets already started to witness some bit of a decline, obviously with deteriorating breadth. These were some of the early alert signals which was witnessed in the month of September. But lately, the rally that we've witnessed from 7th of October in last couple of weeks, largely it was a very polarized rally in the mid and the small markets. And we have seen like a microcap, Nifty microcap index almost making new highs, but the mid and the small caps were significantly below its previous peak. And not only that, the broader market sentiment of Nifty 500 has violated the 50-day average. So, these are some intermarket divergence which definitely indicate that the internal breadth of the segment is giving away. Largely, the rally was more like a polarized rally by a few heavyweights of the mid and the small cap. But these kind of indication is definitely not good, which we have highlighted. And it is more like a portfolio allocation that we recommended our clients to switch out and trim your mid and small caps, get into the classic low beta. But we anticipate the mid and small caps to decline by another 5-10% from the current levels. The small cap index has formed a bearish head and shoulder pattern on the daily charts. Usually such formation leads to an intermediate top, and any violation of important support levels, that leads to a short-term to medium-term bearish trend. So having said that, I think it's a good approach in such kind of an environment where one needs to take a setback and let the extended rallies in this market see some bit of a breather and correction going forward.
It's also Samina joining. It's another 5-10% to go on the mid-cap and the small-cap index. Who do you think is going to lead the way down further? Is it going to be high beta stocks? Because I did read your note where you say best time to hide is going to be low beta plays. So would you imagine that stock sectors such as auto will continue to decline further from these levels despite the recent weakness we've seen?
Okay, so the one of the segments of the mid and the small caps, which is quite heavyweight on names like the capital good names like your BSE, your MCX, your CDSL, they are still very much holding the fort, along with names like Glenmark, Persistent, Dixon. These are the names which have the maximum weightage and which have shown a good amount of resilience and holding the fort for the mid caps. My sense is that you might see some bit of a pullback coming in these names. The broader space have already started to give away, let it be the PSU banks or names coming from other pockets of defense, or they have already declined. But my sense is that within autos, the auto angs which have still maintained its support levels, they are still on verge of breaking down. So I think going forward, the next few weeks will be very painful, looking how the mid and the small caps are shaping out. Unlikely to say if something, you might see some bit of a respite or a trading bounce, but largely I think whenever we've seen such formation playing out, you see a broader markets going and seeing profit booking all across. But since the autos, the frontline names have already declined, I think the auto angs names have some bit of a room on the downside, including the tire stocks. So there will be pain in pockets, but we are strongly recommending that, the low beta space like your frontline private banks, your pharma names, your select IT names, this is the space where one should get navigated into the markets for next few months at least.
Sorry, Manav, good morning, Niraj here. Did I hear you say that people should kind of find the hiding spaces in IT and pharma, or is it the other way around?
Yes. So obviously, I mean, hiding spaces in the frontline IT with frontline pharma names, private banks is where we would recommend to hide, at least in the low beta front. My sense is that even in select pockets of mid caps and small caps, let it be Persistent, Glenmark, your mid caps might witness some bit of a trim coming in, but we are very clearly advocating for next few months to be into the low beta defensive space over the high beta names.
Months, Manav. Did I hear you say a few months? And therefore, does it mean couple of months? Does it mean more?
Difficult to anticipate how the kind of a time phase correction could be, but logically, Niraj, we've seen this formation play out in the past. We are aware the kind of fund flows or the domestic inflows we have. Basis on this, when we had a similar formation happen in the month of end of 21 November, December 21, we witnessed a similar formation which got extended for a period of 4 to 6 months. And honestly, this seems to be a very healthy scenario if it plays out. So if you've seen a 6 months of rally, maybe 1 or 2 quarters of some bit of a pullback, undercarpet correction, a correction of at least 10% to 15% from all-time highs would be quite logical on the larger time scale. But what we are anticipating is an intermediate kind of a correction, a lot of some bit of a shakeouts which could play out in the mid and the small caps. Largely, my sense is that the frontline names might not witness more decline. Maybe the Nifty might just take some bit of a breather or a pause at 24,000. But the mid and the small cap have reasonable room of price correction, but which could further lead into some bit of a time price consolidation eventually. There might be some bouts of trading rallies, but you might come into a scenario of making lower tops and lower lows, and we will wait for that cool off phase to get over before we turn bullish. But at the moment, I think we should let the market take its own course, see some bit of a decline coming in, and then we'll revisit if the scenario changes for us.
Manav, within the broader market space, and point taken that the frontline stocks might not see such a big hit, you might see a breather on the Nifty at 24,000. But within that space, is BFSI looking more vulnerable to you? I'm not just referring to what's happening to Manappuram Finance this morning. Okay, there's some news flow there. But NBFCs, your smaller public sector banks, which have run up a fair bit, are you seeing the pain point there?
See, the PSU banks has already been correcting since last 4 months. We have seen that phase of correction which have already played out. You might see a bit of more knee-jerk coming in because of the market volatility. But my sense is in this market scenario, the NBFCs are usually the which witnesses more hit. Names like Piramal Enterprises, which have been consolidating, has started to dip lower. The L&T Finance, these are the pockets which could see some more pain coming in going forward. But the PSUs in general, I think the first phase of decline is almost over. You might see another dip, but not like a larger one at the moment. So within the financials, I think the way the Bank Nifty has declined, there might be certain pockets where you might see a little bit of pain, but largely I think it's only the private banks, including with insurance, which could be the savior for the space. But largely NBFCs might see some bit of an underperformance going forward. So I have a neutral bias in financials, not very bullish in general, but I would prefer private banks just for the near-term perspective.
Okay, let me talk a bit about your spaces like Zomato. Looking tough today, and I don't know how much you want to go stock specific, but Manav, these are the companies that have really seen the big run up. So let's start by talking about Zomato. Let's start by talking about some in the defense space as well.
Fair. So I'll start with the defense in general. The public sector theme, which has been one of the most darling theme of last 2.5 years, which have seen a reasonable amount of decline. A lot of stocks are down by 20-30%. Some have already seen an overextended decline of 40% from the shipping space. My understanding is that at least the price decline is almost over there. You might see that sectoral churn coming in. The price decline is almost over. You might see a bouts of short covering in case if the market stabilizes in the short term, but there is a phase where the market bottoms out and then eventually consolidates, gets into a lull phase before it resumes on the uptrend. So I think you might see some bit of a no action price kind of a momentum for a while. The price pain is over in that scenario, but not major V-shaped recovery which could take these sectors higher. But largely, I think the pain point is over. Now we need to focus where the pain point could eventually come up. I think that's where one should be a little more cautious about. Talking about the stocks like Zomato, I think this has been on a very good classical strong uptrend move. Any dip of maybe like a 10% from its recent highs has always been a good opportunity to enter for long positions. So, there'll be certain pockets of stocks and sectors which will eventually do good because we are still in a larger bull market. It's just that the intermediate correction would give us some opportunities for long ideations. And I think Zomato as a name does qualify in that perspective. But when we speak, I think on the defensive fronts, yes, Zomato within the mid caps, along with some of the pharma names would be the space where you might see some bit of buying in general, despite of the market momentum. But we still would want to wait and watch and let the market take its course before we come high, because I think the mid caps and the small caps could see a dip of like 5-10%, but not on the immediate basis, but eventually going forward. So at the moment, we would want to wait and watch, but largely speaking, still fine with the Zomato at lower levels.
You're still fine with Zomato at lower levels. How are you feeling about a Polycab and a Havells, both with numbers out? So that's, of course, on the fundamental side, not great for this quarter. And all right, today in this kind of a trading day, both are getting hit. But otherwise, are you feeling like there's an up move there or further pain in store?
See, actually, whenever the price witnesses such kind of a dip on the news front, it's very unlikely that the price recovers, moves higher. But largely speaking, I think you will see some bit of consolidation or underperformance in these names. There might be a pullback of 4-5%. I wouldn't want to read too much into it basis on the result preview, but on the brief basis, both these charts have highlighted some important key support levels on the weekly. I'll let some assessment happen in a while, but there is a scenario where I don't see both these stocks at least move higher on the immediate basis or go to its previous high. So keeping that in mind, I think one can wait for a bit to look or review for any bullish stance into this space in general. But there will be certain pockets which will give you better offerings in times to come. So I think it will be more like a wait and watch approach for a near-term perspective.
What are you doing with auto companies? You mentioned that auto anchors, which have held up, will see some pressure in the next few weeks. But what happens to frontline auto counters as well? Bajaj Auto, or Maruti, M&M, even auto financing companies will throw in there, like Shriram Finance. These counters have had it very difficult. Do you feel like this is now seeming like there could be a dead cat bounce, and hence on the charts they look like good buys for the short term?
Oh, okay. So auto as a space, has seen the first breakdown on its monthly chart. In fact, it started to happen just a few weeks back. We have witnessed also a trend line breakdown. And when the index in general starts breaking below the 100-day average after a good bull market with weak breadth of the sector itself, my sense is that at least for the near term, the intermediate top in the auto is done. You might see another 5 to 10% dip coming into this sector, because cyclically we have seen how, if the correction phase starts in the autos, it usually doesn't stop on immediate basis. It usually sees some more time and bound kind of a correction that plays out. I think the pain point in Maruti as a space could see some more downside in time to come. I think that's been one of the laggards in the last couple of months. We have already seen pain coming into Bajaj Auto, but name like Maruti might see some bit of more downside along with auto anchors and tire names in general. And on the medium term perspective, I think some bit of a cool off into the autos would be the time where you might want to look once the index dips by another 5-10% to reinitiate at lower levels for some bit of re-entry. But at the moment, there will be some bit of a more decline coming in for me. Auto index if I'm not surprised, you might see a decline all the way towards 21,500, 22,000. I think that's where you might see some long-term supports coming into this sector for the near term.
Okay, Manav, appreciate you being with us today. Thanks so much for taking the time out. A bugle of caution. Be mindful of that. That's Manav Chopra. Okay, CEAT, the numbers on the margin front at least left a bit to be desired, and that probably showed on the bottom line numbers. Mr. Kumar Subaya, the CFO of CEAT, joins us right now on the show. Mr. Subaya, good having you. Thanks for taking the time out. Niraj here, good morning. One would have thought that the crude price relief would have shown, but is it the rubber pricing that is hitting the operational metrics? Let's start with that, then we'll move on to the business aspect.
No, you are right. It's largely natural rubber prices, and during the quarter, natural rubber prices in India in the local market reached about 250 rupees per kg level, which is a 15-year kind of a high. And international prices initially were impacted on account of higher freight, and later on in the SICOM also natural rubber prices went up. So you're right. The impact is largely on account of increase in the prices of natural rubber.
And does that stay, Mr. Subaya? We're focusing on a minutiae for a bit because that is what has been the pain point, if you will. So how are prices behaving currently? And as difficult as it is to predict, I would love to understand that when you are putting out the internal metrics of what could happen, how are you penciling that in?
See, honestly, we were able to predict at least one thing. Local natural rubber prices, we were expecting it to go down when it touched the level of 250 rupees per kg, because it was at a significant premium to the international market. So, and to the extent of about 50 rupees per kg. And now that has come down to import parity level. So local rubber prices are hovering around 200 rupees per kg, while international prices have inched up, and they're also around 200, 205 rupees per kg. So if you ask me, in terms of our own understanding of the market, I think our understanding is that natural rubber prices have peaked, okay, and both in the international as well as in the local. We would expect the prices to be either at the current level or could see some small drop going into the current quarter. That is our understanding, because the production of natural rubber is generally higher during this period between October and middle of January. So therefore, there will be more arrivals. Availability should help in terms of meeting any gap that was there in between supply and demand in the previous 3 months. That's the way we see the market.
Mr. Subaya, good morning. Tamanna here. Just trying to understand what is the impact of this key raw material, natural rubber prices, on the margins hit that we've seen of 400 basis points. And since you're saying that you expect natural rubber prices to have peaked, what is the extent of improvement we can expect? Are there other factors also contributing to that margin and EBITDA hit?
No, largely in Q2, natural rubber overall raw material basket increased by about 6% over the previous quarter. Can we expect in Q3 also raw material prices to move up over Q2 in the range of about 2.5%? That's our expectation. And however, as the market has corrected a little bit, particularly in the natural rubber, the future purchase prices will start slowly coming down. What was your second question? I missed your second question.
No, my question is how much of natural rubber prices is contributing to your margins? And if you're saying that the prices are going to come down, then what are you expecting your margins to be next quarter or H2?
No, 6% is what we said, increase in raw material basket in Q2. And 65% of, or close to that, is the impact on gross margin. So it's about, I would say, 3.5% kind of impact it had in Q2. Maybe about 1.5% impact will be there on account of raw material prices in Q3. However, we have taken some price increase beginning of October in passenger car radial categories to the extent of about 3.6 to 4% level, and in case of truck and bus radial, closer to about 2%. So we would have to start mitigating the impact of raw material costs through some selective price increases progressively during the quarter. With respect to our sales to original equipment manufacturer, a reasonable portion of that has a correction mechanism whereby if there's any movement in raw material prices, it gets adjusted in the selling price with a 3 months lag. So we expect these pricing decisions to have mitigate the impact of increase in raw material prices. Going into second half, generally, quarter four is a good quarter and also in quarter one. On the top line, we expect to grow strongly over the same period of last year. In quarter two, we grew by about a little over 8% year on year and 4% quarter on quarter. The revenue that we achieved in quarter two was the highest ever. So therefore, we expect revenue to be growth to be closer to double-digit level over same year period of last year. And on cost side, while our efforts to continuously look at selling price of tires, we have also taken multiple steps to bring some efficiencies in costs, and we are controlling our discretionary costs as much as possible. So these things should help in terms of managing the margins to a reasonable extent.
So the high employee costs which have hit the EBITDA, this is a one-time kind of, or are you expecting this to increase? Your employee bill has obviously gone up, but now are you expecting that to be the new normal, or how do you see that moving forward?
Now, there are two reasons. Our annual increment cycle generally is in the month of July. So there is some impact on account of the annual increment cycle. So on a base of quarter two, there should not be any further impact in the current financial year. However, we also added people. We commissioned our truck and bus radial tire plant in Chennai, okay, and also in other locations to meet the additional production requirement. There's some increase in the employee costs. So it's largely relating to activity. And even in quarter three and quarter four, as we scale up our truck and bus radial tire plant, we would need additional people, and that will have an impact. But it will have corresponding impact on top line.
Just one last point, at least from my end, Mr. Subbiah. Just trying to understand what your outlook is on the demand situation. In your space overall, demand seems to be a concern. Perhaps not in replacement. What is the outlook that you are seeing?
No, I would say it's a mixed bag. We are seeing certainly momentum both in our replacement market as well as international business. Growth in original equipment manufacturers side is subdued. Okay, it's in low single digits, whereas we managed to grow both in international business as well as in the replacement business in double digit. So we see a momentum. Normally quarter three, particularly November month, would be a weak month due to post-festive season. So from that standpoint, we may have a little bit of impact on account of that in quarter three. However, year on year, we look forward to a double-digit kind of a growth driven largely by replacement and international business.
Okay. Sorry, Mr. Subbiah, maybe I missed that answer, but I would just love to have one final question to you. How, with the global car companies giving out the words of caution that they are, what is the impact on demand for all kind of ancillaries? It could be tires, it could be other things, but are we likely to see a period of slowing global ancillary demand which might wane on Indian companies as well with high or low export exposure?
From our point of view, it will have an impact, particularly for those who have high dependence on original equipment manufacturers. In our case, revenue split, about 28% of our revenue comes from original equipment manufacturers. So therefore, we do see some slowdown with respect to demand from the existing customers, and that is also reflected in our revenue. So therefore, we expect that trend to continue at the aggregate and overall level. However, we have also got some additional business opportunities with respect to OEMs in terms of approval of our tires for the new models. And from that standpoint, we expect some growth to come in OEM. It could be relative to the market growth, it could be better. But overall, to respond to your larger question, there could be some impact on growth particularly for those auto ancillaries who have very high dependence on OEMs in the share of business.
All right. Thank you so much for speaking with us. That was, of course, CEAT talking about Q2. High rubber prices has been the pain point for the company, but important point from the management. They're expecting double-digit growth going forward. They're expecting H2 to be good. Mixed bag in terms of the demand environment, and they think rubber prices have peaked out. So that's CEAT for you. Meanwhile, what's happening with the market? Some recovery there coming in, especially on the bank Nifty. Now in positive territory, IT stocks still suffering. Nifty off its lows of the day. Wouldn't say it's turned positive at all, but still off the lows of the day. Nifty IT is still the big pain point. Let's look at the top losers. What's happening with Infosys, Wipro? Are they still hurting the most? Wipro was fine actually, but Infosys largely has seen quite a bit of pain. 3% down now on the stock. Wipro, wow, 5% up. What a gain on Wipro with, the company guiding for a weak Q3. But the fact that their revenue has grown, they seem better than peers as per what a lot of brokerages are saying seems to have worked for Wipro. It's the only IT stock in the Nifty IT at least, which is in the green right now. All the others really hurting. LTI Mindtree, the worst hit, frankly. Axis Bank doing well on numbers. Tata Motors having a relatively good day. So the auto pack is a bit of a mixed bag. I want to pull up Bajaj Auto and see what's happening there. Tata Motors about 1% up. Bajaj Auto, after that 12% knockdown, is not done getting beaten up. Still about 1% down. Is it overdone is really the question. But, in terms of the demand scenario, that has been the big query, right? Are you seeing demand more muted than what was expected? And from what CEAT said just now, he's echoing it.
Yeah, I mean, certainly urban discretionary is not in ship shape. It'll be interesting to see what some of the other results come out as well.
Yeah.
Well, on that note though, it's a wrap on this leg of India Market Open. On the note, as Tamanna said, that the banks are kind of holding out. We'll speak to the management of Tata Communications about their Q2 numbers, as well as Havells on the other side of this break. Stay tuned. Thanks for tuning in yet again, and we shift focus to Tata Communications first. The company reported a mixed set of earnings in Q2 where net profits were lower by 32% YOY, whereas revenues rose marginally. On the QOQ basis, the numbers look slightly better than that. We caught up with the management to speak on the highlights of the quarter gone by. Here's a slice of the conversation that the MD and CEO had with me.
Now, from a growth perspective, this is what we had penciled for. I mean, internally, we have greater aspirations, but the quarter has come out quite well from a growth perspective on the back of both the acquisition, the interaction fabric, the move, the IoT fabric has really done well. So the growth is in line with the expectations that we've had.
Okay. I mean, what stood out? Because I think in terms of what people have said, that managed CPaaS, collaboration, etc., continue to remain growth drivers for you. You've known now to be a both organically growing and acquisitive, inorganic growth-led company as well. Lay it out for us for the first half. What stood out for you in terms of growth?
So the biggest growth came from the interaction fabric, driven by the Color acquisition. The second major growth we had in our IoT fabric, driven by our Move platform, which is more an organic play, largely because we've had an increased usage of the Move platform on the back of increased vehicles that we support, as well as several SOTA campaigns that in the last quarter happened. So these were the two large growth drivers. In the next-gen connectivity, after 2 quarters of a slower growth, we saw in Q2 the growth picking up. So these were the 3 big sort of drivers of revenue growth that we saw in Q2.
And you seem to be focusing on, amongst other things, and please correct me if I'm wrong here, on CPaaS as a segment. Growth-wise, it is strong. I think you're winning orders out there as well, even if deal conversions might have gotten longer. Can you tell us a bit about the strategy here?
Yeah, so we like to call this as our interaction platform. CPaaS is what typically has been used in the past. The reason why we call it as an interaction fabric is we had also the contact center on the cloud as a service. So how do you help customers to take their contact centers to the cloud and deliver a cloud-based service, which is more a voice interaction, if you will, and then the CPaaS were more a messaging interaction. So our vision is to make it all an interaction fabric for enterprise and across multiple channels, whether it's voice and make it more programmable, or SMS and WhatsApp. So yes, we are betting on interaction fabric. We are betting on the fact that enterprises will move to multiple channels besides just SMS. And we're also betting on the fact that these interactions will become more converged, and we need a software layer of orchestration driven by AI. So we are betting on all of these, and we are investing in these platforms to grow.
Is there just trying to understand, because there's so much of confusion around what data is showing in terms of growth, both locally and globally. And then there are optimists who say that communications, connectivity will be cut off from any kind of growth pangs per se. I would love to understand how you think about what's happening to global growth, which might impact your business. And do you reckon that independent of what happens there, you are on track to meet your internal guidances or external guidance as you may have laid out?
So when you say the external pangs on connectivity, see, each of the 4 fabrics that we play, the network fabric, the cloud and security fabric, interaction fabric, and IoT fabric, have their own nuances. So if you look at the network fabric, and in the network fabric, we have 2 components: the core connectivity, which actually connects all the data centers in the country, data centers around the globe. These are, fat pipes that take tremendous amount of data that makes our internet work and so on and so forth, right? So these are the core connectivity. The core connectivity globally has been on a declining trend, even though there is an explosion of data because of the pricing erosion. Globally, the growth is on a declining trend. Whereas what we call as a next-gen connectivity and what we are betting on is the fact that, in the enterprises, the LAN that we have today are all wired LANs is going to more wireless, and the wide area network is moving more to internet, and there is a convergence happening between how LAN and WAN is getting managed, and all of this is becoming software defined. And on top of that, because you're going to internet, because you're going to cloud, the security of this is becoming important as well as complex. And that's an area of big growth, and we are betting on that growth, right? So from an overall perspective, the network as a whole is not growing in market size, but within the network, there are pockets out there. For example, the whole cloud networking and the cloud connectivity is a small niche area today, about 2-3 billion, but it's slated to grow at upwards of 20% over the next 4-5 years. And we have launched our ISO Multi-Cloud Connect product there, which helps enterprises to connect to their cloud providers and exchange the data between the cloud in a more efficient manner. So there are pockets within each of these which are going to be fast growing. But if you look at the entire networking space, that is not growing that much. So we are attacking those pockets, which today might be small, but is going to be growing fast.
Okay, and which leads you to maintain the formal guidance that you'd given out for FY27, no changes there?
Yeah, I mean, that's an aspiration. Aspiration doesn't change. The macro conditions might change, and we have to just keep our heads together, heads down, and execute on what we said we would do.
But is it? I'm just trying to understand. Is it aspirational, or to your mind, it's a realistic aspiration?
No, aspirations have also to be realistic, right? So perfect. We have to pull the entire company. So it's not a dream, let me say.
Yeah. I get it. Okay. Because I think the other thing that most people have written, Mr. Lakshminarayanan, is that, digital growth, margins, etc. will pick up. And therefore, even if growth kind of stays steady in FY25, FY26 could be a year of fairly strong growth. Would that be a fair assessment, or is it difficult to call that right now?
So if you look at so far, year on year, albeit including our acquisitions, we are growing at, over 18-19%. So I think that's part of the whole portfolio. You can't say that you will take the acquisitions we did and take that out of the growth that we are seeing, right? Because all of that, in my opinion, adds value, adds capability, and adds strength to the company for the future. So I would not entirely remove the growth that we are getting through acquisition, because there's a lot of hard work going into integrating those companies, and the time and effort of the company goes into that. So we are quite happy with the acquisitions and the growth it's providing, as well as the capability that it helps us to build and further invest on. So, our aim is to make sure that we integrate all of these very well and set up the platform for the future growth.
So, FY26, a year of faster growth, assumptions not completely out of whack.
So, obviously FY25 has a tailwind of the acquisitions. So FY26, if you look at organically and compare organically, yes, FY26 we will see accelerated growth, and that is what we have to work on. So I commented on some of the order booking the last 2 quarters. It looks positive. I think we are quite excited about where we are.
Got it. Just one final question on a small decimal nuance, if you will. But and again, the assumptions are there in the notes and as per our research team as well. But I would love your sign off on it. The dip in margins for the quarter. There are some one-offs. You reckon the upticks will happen, and return ratios stay at these levels, or do you reckon even those will see an uptick over the course of the next 12 to 18 months?
So from a margin perspective, yes, I think we had a miss in terms of compared to the Q1. And we explained that by the core connectivity, which is a higher EBITDA business for us, that decelerated in growth thanks to a lot of cable cuts that we had. And the double whammy of that reduced growth as well as increased cost to repair all of these made an impact. So in the coming quarters we will work to see how we can recover from that and get it back to at least a 20% by the end of the year is what we are looking at. Because also the the two major acquisitions we did were negative margin companies, and we are integrating that and consolidating that, and that drags the margins down. So all of these will come into play, and we firmly believe that that our guidance of 23 to 25% as our long-term ambition is still very, very executable and doable.
Well, that's Tata Communications, and the stock relatively well behaved relative to a few others which have cracked, and I'll tell you what has cracked. Manappuram Finance. Big brokerage calls there post the development yesterday. Harsh is here with an update on that. Harsh.
Absolutely, Niraj. Let me start off with Morgan Stanley. You've got a downgrade to equal weight, but just in terms of target price, 262 erstwhile target price, now 170. Stock, of course, much below that as we speak. You're seeing what they're suggesting is it's definitely going to hurt profitability. You're going to see a short tenured book, which is generally what MFI is and what Manappuram has, get really squeezed or will likely shrink quite rapidly. Credit costs, which are already elevated, will continue to remain so. Consol earnings forecast, they've reduced their earnings estimates by 20% in FY25 and 30% in FY26 to 27. One-time price to book is what they now value the company at, and this is one-time FY27 expected. JP Morgan too, they've downgraded the stock to an underweight. They believe, again, the key risk here is going to be capital infusion, funding costs going up. Asirvad is 27% of Manappuram's book, and therefore a large chunk of the book will stop growing, and the risk of asset impairment is higher in this particular book. So not only will it be a drag on growth, but a risk of asset impairment being higher. Also, we also have Jefferies, which is suggesting that it typically has taken someone like an IFL 6 months to resolve this, and therefore that will also impact. That's broadly how it will play out.
Thanks, Harsh. Thanks for that. So that's as far as Manappuram goes. Now the other piece is Havells. Because it's the second company we are focusing on. The second quarter earnings saw a revenue move uptick of 16% and a net profit rise of 7.5%. Margins, however, contracted by about 130 basis points. Now, we spoke to Anil Rai Gupta, the managing director and chairman of Havells, to understand why this happened. Listen.
I think, generally speaking, we are quite satisfied with the overall growth performance in all the segments, including Lloyd, but also the positive aspect is the core business of Havells is also firing well in terms of growth. This is a particular quarter where, the expenses for advertising especially have gone up. This is also because of the early Diwali season and, preponing of the expenses on advertising. So we see a 50% jump in our overall ad spends in the quarter. Also, the fact that, there was a sharp fluctuation of commodity prices during this quarter, which affected the margins in the domestic wire business. But that is a sort of a one-off, and we should be expecting normalized margins. So I think we're not too concerned about the margins at this stage, and we are seeing improvements in the Lloyd margins, which was always a concern. So which overall, in fact, we are happy with the overall performance.
So would it be fair for us to assume that you'll continue to grow your top line at the current pace?
Well, I think we've grown at about overall 14.5% core Havells and a good growth in the overall Havells and Lloyd put together. So we are expecting a decent growth. The markets are looking positive. Residential demand is coming in a little bit. The consumer demand, we are yet to see the festive season. It's started on a positive note. So let's see how it goes. But I think, there are a lot of activities going on in terms of channel expansion, product additions. So we should be expecting good growth in the coming times.
And what sort of growth? I mean, Lloyd's contributes about now 11% to your top line, and it's grown at a significant pace of 18.5% YOY, very obviously driven by LED panel. Where do we see Lloyd's contribution to your top line at, say, 1 year down the line?
I think overall, with the growth expected in Lloyd, we are looking at about a 20% revenue contribution to Havells India Limited revenue. So I think it's become a sizable part of Havells now.
Mr. Gupta, how is, with so much of expectation running on the festive season this time, and you also talked about how you've increased your ad spends ahead of the festivities. Are you seeing good traction on back of the festival season underway?
Well, we have to hope for the best. It's a festive season. It's also the winter season for some of our winter products like water heaters. So we put in our best effort. It started on a positive note. Let's hope the November, December, Diwali time also continues to remain the same. So we are definitely, entering the festive season with a positivity. So
early channel checks are indicating or keeping in line with what the expectation was, right?
Yes, that's true.
Right. So, Gupta, we talked about, of course, how margins are impacted and raw material prices have been volatile. Of course, with everything happening on the LME and taking place in China, it does seem like raw material prices or commodity prices could be on the uptick going ahead. But you're still of the opinion that margins will normalize in the next few quarters. How do you plan for that to happen? Are you looking at hedging? Are you considering a hedging strategy? Captive commodities? What really is the plan? What will help margins? Or will you be in a position to pass that on to your customers? How are you going to make that work?
Usually in cables and wires business especially, deep fluctuations sometimes affect the margins. But if there is a constant, slow increase or a reduction, it usually gets passed on to the market in the same manner. And that's what we would hope. We would, if the commodities continue to rise, it will be passed on to the market. What it can affect is the overall demand. But I hope that it continues to remain. It's still, I would say, the copper, aluminum, it's still at a very high trend. So India is maintaining this growth despite this inflation. I think it's a positive thing. Over a period of time, if these things normalize, I think we will expect better growth, coming in from infra as well as residential segments.
So, Gupta, your inventory levels have shot up quite significantly, about 60-odd%. You want to tell me why?
I'm not sure about the number. I don't think it's 60%. But anyway, inventories we do increase inventories pre-season because there are, capacities which need to be, the products have to be manufactured just for the season. For example, lighting, water heaters. So I think this is quite normal entering into the third quarter.
Also, there was a big increase in other income, 77% rise. You want to tell me what was that made up of this quarter?
Well, nothing in particular, but, because the company has enough cash resources and the interest rates are also high, so that could have led to the increase in the other income.
Right, going into the next couple of months and looking a few years out, are you making any investments in any of your verticals? And if yes, where is it? Is it sitting on product innovation, building out your distribution channels? Where really will the next kicker of growth come from for the next 2 to 3 years out?
In fact, all of it, product innovation, we are increasing expenses on our R&D because, it's not just to increase sales, but the customer expectations are also rising more and more towards premium products. So there's a lot of investment going in towards R&D. On the other side, CapEx investments are going on to take care of the future growth. And thirdly, with the rural areas now coming up with electrification, there is a huge level of investment going towards rural build-up and channel build-up in semi-urban areas. So investments are going, I would say, in all these three areas.
Also, in terms of funding all these aggressive plans, because that's the only way to grow is to keep, of course, being greedy when things are slightly slowish or uncertain. How would you look to fund all of these very ambitious expansion plans that you're already investing in?
I think we have quite aggressive CapEx plans for the next couple of years. But from our internal accruals and cash reserves, we should be able to manage without any external fundraising.
So no external fundraising on the map, just yet. Say, Gupta, also, while we talk about expansion, would you look at inorganic expansion at this stage?
Well, this is a constant process. We have done in the past, but, we do look at things very prudently. And I think, nothing is closed, but, we are always open to look at inorganic expansion. But I think there's enough juice for growth in our organic businesses as well.
The last few months ago when we spoke, you talked about how you had very big plans for the international markets as well. You want to walk me through where things stand? Where do you see that go in the next couple of quarters? And how would that contribute to your geographical mix as well 1 year down?
I think we are making strides in terms of creating structures and infrastructures for, having a long-term sustained international business. We've set up a couple of joint ventures in the US. We're looking at distribution enhancement in Middle East and Africa. So there is structural work which is happening. The results will take time. There's a lot of product development, product certifications which are required to get into these developed markets. So I think going forward, next 1 or 2 years will be more of like an investment phase. And we should be getting good sales from international business in the next couple of years.
Right, and that, of course, will also, I'm assuming, be better margins. So all of that will contribute to a further uptick. Mr. Gupta, yes, please continue.
It could also mean operating leverage for the existing businesses. So yes, it will enhance margins.
Right. Also, you did indicate to me just at the start of this conversation that you see margins normalize. Is it a fair assumption for me that once these ad spends, which is a one-off in this quarter, and we go into the next quarter where you have a heavy festive demand, reflecting on earnings, we should be back up at 9.5, 9.6?
Yeah, overall, the way we look at it is Lloyd separately and Havells Core separately. Havells Core, we are always targeting between 13 and 14%. So I think we should be coming back to at least, if not in the third quarter, at least in the fourth quarter. So overall, we are looking at those kind of margins.
Okay, that's Havells. So hopeful about some demand uptick in this season. Pull up that stock for you and just see what that is doing in trade. Can we get Havells on the screen? Up about 1.6%. I think the issue though is Wipro, is IT, and this is happening despite Wipro. So let's pull up Nifty IT and let's pull up the Nifty IT constituents on the screen, because that will show you that Wipro is in the green. And doing well, but look at the others. If you pull up on the wall as well, but LTI Mindtree 5.5% lower, Infosys 4% lower. Then there is Tech Mahindra and some of the others which are also coming off. So IT is facing a problem in this session today. That is the worry. Save for Wipro, everything else in the red, and which is an issue. Nifty small cap down about 1%, but Nifty 100 is down just about 1/3%. So therein is not a problem. It's IT on the large cap side, and then some small caps which have cracked quite strongly today. But there are ticks of green, by the way. I mean, seeing some stocks which are kind of holding out well, which is actually a rather good sign. No breakouts, by the way. No breakout alerts, sadly, in the session today, because largely stocks have corrected. And that is the key thing to watch out for. Quick Heal should come up on your screen and just see what that stock is doing, because that was down about 9% at a point of time. And that will come up on your screen. It's still down about 9.5%. So that hasn't had a good outing at all. We should get Polycab. It has recovered from the lows of the day, but still down about 3%. So watch that too. IGL, MGL getting pummeled out of shape. What if there is a price hike that comes in? IGL is down 11%. MGL is down 14%. The key to think that what if there is a price hike? So it's Manappuram, MGL, IGL, Quick Heal. That's the list of stocks which is really taking it on the chin. Capital market plays too are down because 5 Paisa, 361, etc. are trading lower. I just wonder though, one last thing, whether IIFL Finance and Muthoot Finance, how are they trading? Because what is Manappuram's loss could well be gains for these. Somehow they aren't quite reacting. What is standing out? Ajmera Realty, Tejas Networks, Paradeep Phosphates are amongst the stocks that are doing well. We wrap it up on this leg of Talking Point. Thanks so much for tuning in.